Recording in progress. Recording stopped.
大家好，我是燕燕。我从小生长在一个富裕的环境，所以从小无忧无虑。我也不知道什么叫做理财，我也觉得我不需要去做一些什么理财。可是当我长大念完书，大学毕业之后，我发现我没有目标，那我只能去上班，而且呢，我只能把钱存在银行里面。
大学を出てからはずっとサラリーマンをやってました。もうサラリーマン一本ですね、収入源が一つしかないということで、定年を間近に控え、このままでは将来に不安があるということで投資にはいろいろ手を出しました。
我就係一個普通嘅大學生嘅。當我畢業之後，我就發覺我係需要一個投資嘅計劃啦，去好好咁樣去處理我嘅人生同埋我嘅理財計劃嘅。
後來呢，當我遇到了結婚對象，我的對象他是學財經的，而且他在銀行上班。我想說，哇，我的人生有希望了。於是我把我的積蓄通通交給他，讓他去做理財，去做投資。可是沒有想到過了幾年之後，我發現他做的是投機而不是投資，於是我們的積蓄都沒有了。又加上呢2個女兒的出生，我從一個本來很富裕的生活變成了月光族，也就是每個月薪水花光光。
バイナリーオプションであるとか FX であるとか、日々値段を追って徹夜したこともありますけど、ほとんど変わらないというか儲からない、もうことほと疲れて、もうどうしよう、もう投資はダメかなと思った時に出会ったのが株式投資でした。で、株式投資でもいろいろやり方があると思うんですけど、長期的なやり方があるということで、それにすごい興味を惹かれました。
所以咧，我就特登去參加咗 Katon 老師嗰個嘅VIA 嘅 course。咁我投資之前就真係完全係冇接觸過任何投資嘅，最多都只係喺大學度有上過關於可能係 finance 啊，又或者 account 嘅知識嘅啫。咁就完全冇投資嗰方面嘅任何知識。咁所以我就最後尾決定咗去試下 Katon 老師個嘅 course，咁然之後睇下會唔會對我嘅生活有啲咩嘅改變咯。
我每天過着這樣的生活，我真的看不到未來。但在去年我接觸了價值投資之後，我發現原來可以透過學習，讓我們自己翻轉自己的未來，讓我們有機會可以獲得財務自由。
バリュー投資という、長期的な投資をやることによって日々株価を追わなくていい、ゆったりした気分で、長期的に見ていくということで、またリスクを抑えてやるというところで、年も年なんでリスクっていうのはやっぱり避けたいというところもあるんで、そういったのもうまく、自分の希望も叶えられる投資というので、それを実践して、やっているんで、結構ゆったりと精神的にもゆったりとした気持ちで、取り組んでおります。
我今年已經52歲了，而且我有2個女兒，我現在也是單親。我相信我可以做得到，你還有什麼做不到的呢？那讓我們一起加油學習吧。
我本身係冇任何嘅投資嘅知識，亦都冇任何投資嘅經驗，我亦都冇咁多嘅時間可以做其他嘅 part time 同埋 freelance。咁呢啲嘅因素都冇影響到我去學習投資。咁你依家仲喺度等啲咩啊？
我在 VIA 學習投資。
私は VIA の卒業生です。
我係從 VIA 嚟嘅。
私はケイデンのクラス卒業生です。
我是從 VIA 學習的。
咁你呢？
那你呢？
那你呢？
Testing, testing. 1, 2, 1, 2. Good morning, everyone. Welcome to the Autopilot Investing for Financial Freedom this morning. And just before we get started, because I know that a lot of you have just started posting some interesting notes and observations, if you just do me one favor and basically on the chat, just basically type 1 if you can see me and if you can hear me okay. Could you do that for me? Just type 1 on the chat, please, for me. Thank you so much, guys, because I'm just getting a little bit nervous in terms of the process, because all the technical parameters need to be in place, and it's taking us a bit of time this morning to align the IT. But I'm glad everything is working, so fingers crossed we're going to continue on the same basis. So again, good morning, everyone. It's great to have so many of you. I think it's about 81 people sort of on board this morning. So great to have you on board. My name is George, and I am going to be the MC and one of the presenters for today. And I'm very excited for what we're going to be covering, because at the end of this session, what you will learn will actually allow you to invest safely, to invest in a calm and risk-free manner, and effectively allow you for the rest of your life to generate income. So it's going to be really exciting. It's going to be very interesting and applicable to all of you. So I am thankful for your participation. I'm thankful for your time, for waking up this morning to actually attend our Autopilot Investing here in Value Investing Academy. So basically, I just played a little video to present the situation with who we are as in Value Investing Academy. And you've probably seen a few people from different parts of the world dialing in and basically sharing their experiences from Japan, from China, from Taiwan. I'm actually a location where you probably won't be able to guess at this time. But if you stay long enough for the presentation, I will reveal where I'm dialing in from and what time of the day is here. But it's morning for you in Singapore, and it's great. So you don't have to worry about any other parameters as far as where I am based. So what we're going to cover today is basically exciting sort of things around investing. And frankly, the video you've just seen with the participants of Value Investing Academy are all basically stored, all basically available in YouTube in Value Investing Academy. So you can see the sort of link in here on your screen is youtube.com Value Investing Academy. So in here, you will find a lot of interesting information. There's regular updates that get to happen, and you get informed about this. If you subscribe, if you sort of watch the channel regularly, the interesting things in relation to deep dive series where basically people from value investing, trainers, and other people who generally sort of participate in the process, they are effectively doing analysis of stocks, industries, everything that's exciting at the moment and of interest to you as an investor. And a lot of other interesting things, including lessons from famous value investors. Just as an example, down here, I'm just going to circle this area here. There's a very interesting video from Lauren Templeton about how to invest in the stock market. I was actually very privileged and Lauren Templeton a few years back when she was visiting us in Singapore for one of the investment seminars we had. And I highly recommend to sort of watch some of those videos, because you will learn a lot of things. You won't have to go to too many different places. And you'll see during the course of the presentation today, there's going to be a lot of interesting information around investing that you can take advantage. You can really sort of start using in your investment journey. And there's a lot of good stuff in here. So having said that about the channel that we've set up in Value Investing Academy, there's a QR code that I'm just putting on the screen for you. It's slightly coming up. There's a small delay. But yeah, you should be able to see it now. So if you don't mind doing me the favor and taking your phone out and scanning the QR code, that will actually take you to the Value Investing Academy YouTube channel. and you'll subscribe to that. You can just click onto the subscription concept, and basically you can get updates on a regular basis. You don't have to worry about going there whenever you have time as to whether some new video has been uploaded. You get notifications straight away. And as I said, there's a lot of very interesting information around there's a lot of interesting information around sorry, somebody's just saying that the video is too soft, so I'm just trying to adjust my microphone settings here if it's possible. I hope you guys can hear me a little bit okay. Is that okay now? Could you just type in 1 on the chat, please, just to see that you can hear me okay? Okay. Okay, thank you. Better, somebody says. Okay, thank you. Thanks, guys. Appreciate it. So basically, if you don't mind sort of scanning the QR code and just go into the YouTube channel and subscribe it into our channel, it's going to be interesting because you'll get all these notifications without having to worry. There's always sort of new stuff and always exciting stuff that you guys will be sort of notified. And if you don't really like to continue, then happy to pull out, I suppose, unsubscribe. But generally, this is the process. And a lot of information, as I say, is actually uploaded on the channel on a regular basis. A lot of interesting information there. So that's the Value Investing Academy YouTube channel, where there's a lot of info there. And I highly recommend you guys going and checking it out. So moving on to, I guess, the presentation for today. As I said, I'm not at the moment in Singapore, but I guess a lot of you, perhaps most of you, are based in Singapore this morning. You must have seen the news about inflation in the country, and one of the latest sort of headlines I've pulled out from the news. It's just a couple of days ago, actually. I think it's the 23rd of August. It talks about the core inflation, where basically the numbers are now starting to come down. So Singapore's core inflation is actually coming down to 3.8% in July. That's the latest sort of number, which is apparently the lowest in more than a year. Now, if you were following the news, a few months ago, that number was around 5.5%, 5.6%, I think it was reported at some stage. Now, I'm pretty sure you guys are going out and about, you know, buying your groceries, having your coffees, you know, spending money in the country on a regular basis, on a day-to-day basis. And I am really convinced, because I lived in Singapore for many years as well, that this 3.8% or 4% or 5% or whatever is normally sort of declared on the headlines is not exactly felt by you when you actually make those payments. Because costs of, you know, things such as food and transportation, coffee and everything else that you use on a daily basis has really increased by a significant amount, not just by 3.8%. And the reason why that is, and the reason why we have in these news announcements such low numbers, is because, as I've just underlined here, the numbers are talking about the core inflation. And the core inflation is a measurement of the inflation parameters in the country, which excludes public transport, food, and so on. If you actually take these things into account and you start calculating the real cost of inflation, the number is definitely, and you all know it deep inside you, much, much higher. So it's interesting to realize that, you know, we need to understand, you know, how do these things affect us. And frankly, if you are keen or interested to understand a little bit more about inflation and the way it really affects our day-to-day lives, instead of looking at the core inflation, you can search and look something that's called CPI. CPI stands for Consumer Price Index, and effectively takes into account most of the things that we are affected in terms of costs on a day-to-day living in all countries around the world. So the CPI, and effectively the cost of living and in inflation for food, has definitely definitely risen much more than 3%. And what can we do about it is obviously the question. It's a good question, and I have a little picture of myself there because, you know, a few years ago, I started in the same way, I suppose, that most of us are sort of doing, where we're just having a job. And a job basically allows us to offer some services to our employers, and our employers are then paying us a salary, right? So that money comes into our accounts. And what happens is that automatically, autopilot goes to the CPF, goes to our pension scheme. And as you all know better than me, in Singapore, we have the ordinary account at 2.5% per annum as a sort of adjustments to the process, or the special account at 4%, effectively multiplying our contributions to the CPF. Now, something interesting here about the lifestyle, and this is what I said earlier about the core inflation. It was 5.5% in January. It has come down to 3.8%. But we all know that the expenses and the cost of things have just gone up substantially. In order to maintain our lifestyle, we can't just survive only with just the salary and putting some money aside for the rainy day for the pension. So a lot of people these days have started thinking about, banks and interest that they offer. Now, obviously, most of us, we have a bank account. The salaries we have come into the bank accounts, but there's an additional sort of incentive these days by the banks to leave our money into their accounts. And recently I was reading news about the actual interest rate that they offer, and they fluctuate, or they range between 0.05%, which is actually one of the lowest figures that a bank should or could offer, to 4.8%. And just this morning I was looking at numbers in Singapore. There are some banks that they even offer higher interest rates. The challenge with that, though, even though it looks quite interesting and inviting, is that these percentages, particularly the upper range, so I'm referring to, in this particular case, the 4.88%, to achieve the 4.88% bank interest, you have to go through a lot of hoops. You have to make sure that you have your salary, you spend money, you do a lot of things. You might have a minimum amount that you need to always maintain, and so on and so forth. So it's not as straightforward as it seems. It looks nice on the paper, and it's a great marketing tool for banks. But once you start looking under the surface and understanding what does it mean and how can I achieve this high percentages that the banks are offering, it becomes a little bit more difficult, a bit more complicated, and it's not exactly what it normally shows. But nevertheless, a lot of people are interested in, keeping the money in the bank because effectively the bank interests at the moment, interest rates, they've gone up, and what they offer is, it looks quite interesting. In addition to that, we have in Singapore SGS bonds, which stands for Singapore Government Securities Bonds. And also another product, which we're going to talk about today, and we're going to cover it in great detail, is the Singapore Government Savings Bonds. These range between 1.6% to 4.8%, as you see on the screen here. And they are a very interesting sort of product that we want to explore as one of the ways that we can optimize our investment journey. We can start to understand what works best for us and how we can really sort of take advantage of what is in the market. Just for clarity and perhaps for completeness, I will throw in something that recently has become quite exciting for people in Singapore. These are called treasury bills, as you can see on your screen. And treasury bills are basically similar to bonds, are basically government securities that they're issued, that they have a duration of 6 months or 1 year. And as of March 2023, the rate, the interest, the coupon rate, the return that they provide is somewhere between 3.6 and 3.7%. As a matter of fact, right now for August 2023, that number is around 3.73%. It doesn't really change much, but it's an interesting sort of component that people excited, I suppose, about the whole process. However, as you can see on the screen, we have CPF, we have the interest from the banks that we could potentially tap into. We could invest in bonds and perhaps get a similar sort of amount. But if we really look at the bottom line for us, the inflation that affects us, not necessarily the core inflation, but the inflation that has impact on our day-to-day lives, it doesn't actually cut it. The inflation is most of the times higher than these numbers that we're seeing in relation to what we can invest. So what we really do? It's really the question, and I think the exciting thing for us today in terms of discussing the benefits and the interesting subjects that we're going to cover around investing. Now, Caden Chang, who's the value investing founder, he likes this sort of slide, and he asked me to include it into the presentation today. And it's very interesting because he has a dream, he has an aspiration to go and sit in this wonderful bench, which you can see here, and basically look up in the mountains that are in the background, beautiful mountains full of snow. And as you probably guess, maybe some of you have already visited this country. That is Switzerland. And if you really want a lifestyle that allows you to visit Switzerland and, you know, breathe the fresh air and sit by the lakes and see the beautiful mountains, you got to pay some money. You got to be able to, you know, get on a plane and travel and come to Switzerland and basically see all these wonderful places. And therefore, you need a specific lifestyle that allows you to do it. Now, you could do it with your salary, working hard and putting money aside. And hopefully, you know, once a while, you could become able to go to Switzerland and take advantage of the wonderful place. But what we're going to talk about today is basically creating the lifestyle we want, creating a lifestyle that will allow us to do these things without having to worry about whether somebody else could give us the money, whether a job is able to give us the ability to travel into these places. And it's of course a personal choice, because you don't have to go to Switzerland, you don't have to see these things, but everybody, I suppose, deep inside has got some sort of form of a dream lifestyle that they want to achieve, right? That's what we do. That's what we are investing. That's why we put money aside so we can experience a better quality of life. That's really the bottom line. It just happens to be Switzerland in this particular case. And it's interesting in our discussion today, because I'll get back to this again. But effectively, what can we do to achieve this sort of lifestyle we want, right? And one of the standards, I guess, approaches, one of the interesting steps that most of us take when we start our careers, when we get a job and some money, is effectively try to put some money that we haven't spent, basically put that money aside and save it. And the first place that could actually happen, that could actually sort of be positioned, is either cash, or put it in a bank, or whether, you know, we want to be a little bit more sophisticated and improve our returns, perhaps by investing some of that money into bonds, which we're going to talk about today, because it's a very interesting subject around the first step that someone who hasn't started to invest, can really take and improve his confidence and her ability to really enter the space. So you can either put that money that you've saved into a bank account, leave it there, and as we've seen earlier, maybe you get some good returns depending on what the bank provides, maybe in the amounts and the requirements they have. Or you could start looking at something that is a little bit more advanced, such as bonds. And we're going to talk about particularly government bonds here, which are capital protected, and they have a fixed ROI, a fixed return on investment in the whole process, which will give us some interesting thoughts about where we could allocate capital. Now, that's just one way to put aside to start investing in the whole journey as investors. There are many different approaches, and as you'll see, and assuming that the money that we can put aside for investment purposes is 100%, so it's 100% capital here. We can put a certain amount, and if you look at the circle here, around about 20% perhaps on cash or bonds. But then we have other sort of ways to optimize our investment journey. So CPF, we can maximize our potential and our investment positions under the CPF. Normally we have a presentation on the autopilot scheme about CPF, but not today. We won't cover CPF, but we'll cover something more, something different, equally exciting, So the other interesting thing is to do passive investing, where effectively investing in ETFs. They stand for exchange traded funds. And basically those can achieve 10 or more % a year. And what we'll talk about today is something on this subject where we're going to talk about ETFs in the US. So that's another way of putting our money into good use. The other sort of alternative is invest with funds, invest with entities that they are operating in the market, or understanding the investment journey better, we can go into stocks and invest in particular stocks that we have researched, we have confidence in those, and we are seeking a higher ROI. And for those who are probably scratching their heads thinking what ROI stands for, because there's a lot of abbreviations in the world of finance, that is the return on investment. So ROI is return. Let's write this here. Obviously, what we want to do is we want our ROI to be as high as possible, right? So these are some of the ways that we can learn, we can optimize, we can adopt in terms of our investment journey. And today we won't be able to cover all of them. Obviously, it's a 3-hour workshop. So we have 3 very interesting sort of subjects to cover and 3 presenters, which will cover some of these components. And effectively, if we go into the webinar's sort of information, we have 3 wonderful people. We have Hillary, who's our equity research analyst. Hillary will take us through something very interesting in a short while in relation to bonds. We have Yang Zi, who's going to cover some interesting components and exciting sort of developments around stocks. And myself, who at the end of the webinar, I will reveal some interesting information about ETFs and how you can start investing right away and take advantage of the information and the accessibility of it straight away, right after take your first steps basically in the investment journey. Now, the interesting and the first presentation we'll have is around the Singapore savings bonds. Okay, Hillary will take us through this presentation, and I'm really excited to have Hillary with us today because Hillary is our analyst in VIA and she has done a lot of research, a lot of analysis on stocks, on industries. I always get really excited hearing her insights about the markets, and a lot of the analysis that Hillary does, they are normally uploaded on the YouTube channel. So you can go there on the VIA YouTube channel and see a lot of interesting developments there. And Hillary today will just talk about methods are applicable than traditional banks' interest rates. You know, I've talked about interest rates earlier and people getting a little bit excited about the banks at the moment. But basically, the interest rates that they offer, they could be, or they could look attractive, but they could be something that you might end up being disappointed at the end. Hillary will talk to us about something which is a product that the government has created to provide guaranteed returns. And it's a very unique product because I can tell you guys that not that many products out there that they offer guaranteed returns. And apart from the guaranteed returns, they offer 100% of our capital. Okay, so all of that, everything we put in is protected and is backed by the government, by the Singapore government. The interesting thing to note here is that what we're going to talk about in terms of the Singapore savings bonds is not to become millionaires overnight or look at fantastic and excessive return on investments, but instead start our investment journey with something more sophisticated, something better than just leaving our money to the bank, in the bank, to basically make whatever returns it could make. Instead, we could take the step to learn about investments, understand the bonds, and basically be able to invest in something that will give us better returns than just having to leave our money in the bank. That is really the approach we're taking here. And this is the first step in our webinar today, where we're going to take you from, I guess, an interesting level of assessment, starting with bonds that, as I said, they're better than banks' interest rates. And then we'll progress into higher return on investments that we can seek and we can secure as investors. Now, having said that, I will stop sharing my screen. I asked Hillary to come on board. Hillary, thank you for coming, for being with us this morning. I hope just kind of stop sharing my screen and you can come in and share your slides and put your camera on.
Yeah, morning. Early morning, George.
Fantastic. Hillary. So without further ado, I'm just going to sit back. I will give you the floor. Welcome on board. And please take us through the Singapore savings bonds. Thank you.
Yep. Okay, thanks a lot, George, for the wonderful introductions, and good morning to everyone. So I'm glad that each of you are keen to learn more about how you can invest and then grow your wealth this morning. So may I do a quick chat with every one of you? If you find that my audio is just nice, it's comfortable for you, can you please type in 1? And if it's a bit too soft, can you please type in 2? So I'll wait for a short while to see whether is there anyone having some audio issue before I proceed on. Okay, Ken. Okay, Ken. So thank you for everyone who has responded. So I think this volume is just nice. So once again, good morning, everyone. So today, as George mentioned, I'll be sharing more about Singapore savings bond, which was not being covered during the YouTube channel. So I'm quite excited to share about this because previously this was being shared by George, who was actually, I learned from him. So today I'll do something slightly different from what he has shared previously if you have attended the previous session. So with that, without the further delay, I'll just proceed in. Okay, give me a moment. Okay, can you all see my slides? Okay, so if my slides is doing well, then I'll proceed on. Okay, so for this morning, I'll be sharing on the Singapore Saving Bond, which is one of the bonds offered by the Singapore government. So before that, let's do a quick disclaimer. So here we are only illustrate on some applications of value investing methodologies. So here the information provided is just it's not a recommendation to buy, sell, or hold, but we are merely sharing some information that is useful for you to make a wise decision on how you would like to invest or grow your wealth. So in no event shall VIA or any author for today's event be liable to any viewers, guests, or third party for any damages that may arise of the use of this content shared here. So neither Mindkinesis Investment Private Limited, Value Investing Academy, nor the authors are operated or affiliated with any broker, dealer, or licensed financial advisors. So with this being done, then we shall proceed for our today's session for today. Okay, so here are some of the bonds that are being offered by MAS. So the bonds that usually MAS offered, there are two main categories, which are individuals and institutions. So here institutions are mainly for the large financial institutions like banks, hedge funds, or as such. But for most of us, we are retail investors. So we will be looking into individuals where there are three types. So the first one is the Singapore Saving Bonds. And then the second one is the Singapore Government Securities Bonds. And the third one is the T-bills. So for today, we will mainly sharing about Singapore Saving Bonds. So these two we will not be covered for today's session. Okay, so right now you might be thinking that other than the bank, why should I consider MAS bonds as another investment vehicle to put my money in? So the first thing is that because all these bonds, they are fully backed by the government, so they have a AAA rating. So that means when you put the money with the government, you can be rest assured that your money, your principals can be returned, can be get back. Because one thing they were concerned is that if let's say we put our money into certain bonds, like for example, some company bonds or corporate bonds, we are concerned that whether can the company last or will they default. Because once if the company having issue and they decided to declare bankrupt, then there goes our principal. So this is something that we are very concerned about. But because all these MAS bonds are being backed by the government, so they have a AAA rating, which means that rest assured you can still get back your principals or your money after the bond has ended. And then next. Okay, so for these bonds, mainly for Singapore saving bonds and also SGS bonds, you'll be able to earn regular interest, but not for T-bills. So T-bills, you pay at the discount. So that means if you already get back the interest payment upfront. And it's another way you can diversify your investment portfolio. It does not mean that this is put all your money into the bonds and let it grow. But it's another way you can consider to put your extra money or your rainy day funds into these bonds to grow your wealth. And the best thing of all is that it's tax exempt. So that means all of the interest income that you gain from Singapore saving bonds, SGS bonds, or T-bills, they are not being taxed. However, for Singapore saving bonds, it's non-transferable. So that means once you purchase the Singapore saving bonds, you can redeem it at any month that you want, but you cannot transfer to another party. But for Singapore government securities and T-bills, you can actually sell it on the Singapore Exchange, the SGX, if you wanted to get out of these bonds. So later I'll share more about these 3 bonds feature in the later slides. Okay, so before we proceed, let's watch a short video that is being done by MAS to introduce what is Singapore saving bonds and what are the interesting or attractive features that they offer. So with that, give me a moment to share. Okay.
Have you heard about bonds?
Are you guys able to hear the audio? If yes, then I'll proceed to play with the video.
Have you heard about bonds? Nope, we're not talking about him. Although the bonds we're talking about help shake up your investment options. Say hello to Singapore Savings Bonds. It is a safe and flexible way to save for the long term. Safe because they're backed by the Singapore government. And flexible because you can exit in any month without penalties. It's great when you need cash for rainy days, or if you're saving for retirement, or that family holiday you have always planned for. The best part is your interest grows over time. So flex your money. Grow your savings with Singapore Savings Bonds. Find out more about SSB now.
Okay, so now can you all see my slides now? Okay. So another credit being given to MAS for doing such a wonderful and beautiful video to let us know more about what is Singapore saving bonds and what are the features that is being offered by this bond. So for today, we will further deep dive into what this bond really is, what it offers, and how you can buy or redeem it. Okay, so first thing is, what is Singapore saving bonds? So it's actually a safe and flexible bonds for all individual or retail investors. So the bond duration is usually maximum you can put your money into this bond for up to 10 years. But in the event that should you need the money, then you can actually redeem it in any month without any penalty. Because we know that if we put our money into banks fixed deposit, you have to put it, like, for example, 10 months, and you cannot touch the money. And you should, if you wanted to get back the money from the fixed deposit, then you need to pay a certain penalty in order to get back the money. But for Singapore saving bonds, there's no penalty imposed if you need to redeem it in any month during this 10 years duration. And the best thing is that the interest rates actually increase over time, which is called a step-up interest. So that means the first year is, let's say, 3.01, then the interest will slowly increase over time until the 10th year where the interest is 3.2%. So for here, you can see that this month's bond, which is the August being released, the average return over 10 years is 3.06. And if you can see the smaller note here, it mentions that from year 1 is 3.01% until year 10 is 3.2%. And the best thing is that you can still apply it this month because the closing date is on 28th August, which is on a Monday. Okay, so now what are the benefits that you should consider SSB to put your money in? So first thing of all, it is safe because it's fully backed by the government and you can reclaim it back in full. Let's say if you want to redeem in early or if you wanted to hold it to maturity for 10 years. And because it's fully backed by the government, so there's no fear of capital loss unless, touch wood, Singapore government defaulted, then that's another story. Okay, so long term, you can invest, you can put your money into this bond for up to 10 years with step up interest. So that means the interest rate is not fixed. And the longer you save, the higher the interest rate. So this one we will also explore more on how does this step up interest actually works. And best thing of all, it's flexible. So you can redeem it at any month that you want. And there's no penalties if you wish to get back your money. Okay, so now let's look at how does SSB work, or in general, how does a bond actually works. So let's say, for example, an investor, they have a certain amount of capital. So for here, the example that I'll be giving here is $500. So they will say that I have an extra $500 where I wanted to find a place to put my money and grow my money. So the investors can actually have many choices to put his money. Like, for example, he can keep his money in his house inside a Milo tin, but most of the people won't do that. Why? It's because when the money is put inside the Milo tin, it cannot further grow the money. So that is one of the reasons why people put their money inside the banks. So other than the banks, where are the other investment vehicles that the investor can consider to put their money to grow their money? So here they may consider bonds. So here we'll give an example of SSB, Singapore Saving Bonds. So for Singapore Saving Bonds, let's say the duration is for 10 years. And during this period, every year, they'll be able to receive 2 times of interest payments. So based on this month's Singapore Saving Bonds, the issue date for the first interest payment is on the 1st September. And then 6 months later, they'll receive another payment. So for Singapore Saving Bonds, the interest payment is actually 2 times per year. And if you get this bond for this month, so the maturity date is 10 years. So you'll be get back your principal in full in 2033. So this one will cycle for the next 10 years should you put your money to hold until maturity. So here, if let's say you need to redeem it early or you decided to hold it to maturity, the government will still pay back your capital while you'll be collecting interest payments 2 times per year. So here, the investor is actually earning interest payment every 6 months for every year. So this is how it actually works for SSB. Okay, so now let's look at how does this step-up interest actually works. So here, usually when you go into the Singapore Saving Bonds website, they will just show you upfront that in average return for over 10 years, this is the interest rate that is being offered. But if you look into further details, if you click here, you'll be able to see these interest rates. You'll be able to see this interest rate, and you can see that from year 1 until year 10, they actually listed out what are the interest rate that were being offered for these 10 years. So you can see it's starting from 3.01 until the 7th year is still 3.01. It's only until the 8th year onwards, then you can see the interest rate actually increase to 3.14, then becomes stable again in year 9 and year 10, which is 3.2. So people might be thinking, maybe I should wait until year 10, then I put in the money. It does not work this way. It always starts from 1 until 10. So that means you have to hope for the whole 10 years in order to get this 3.2. But if you average out the 10 years, this is the rate that you'll be getting, 3.06. So this is what they showed here. Okay, so this is how the step-up interest actually works. Okay, so next. So now we know that how much is the interest rate that I might get should I buy the Singapore Saving Bonds this month. But in terms of money value, how much do I actually earn? So here let's play a short game, because on the MAS website, actually they offered a calculator where you can try to test it out to see how much should I put and how much will I get to earn. Okay, so here when you click into the Singapore Savings Bonds and you scroll down, you'll be able to see these 2 parts. One is the Singapore Saving Bonds interest calculator, where you can calculate like how much of the interest payment will I be able to get for if I hold to maturity or I decided to redeem early. So we will see the examples later in the later slides. And here, if you are curious that what are the interest rate for the past saving bonds, so here are all the historical rates, which I will not deep dive into here. So you can play around on the website to find it out more. Then, okay, so once you click in here, you'll be able to see that you can try out to see what are the interest payment they are. So this is, the first thing here is, so here you choose the coupon that is the bond that is being offered for this month, the latest bond. Then you put in the amount. So for Singapore saving bonds, it's in multiples of 500. And in this example, I'll be giving it in 1,000. So let's look at the first example. If you decided to hold it to maturity, that means hold for 10 years. Okay, assuming that you applied for $1,000 for the Singapore saving bonds in August this month. So you can see that for the first year, there are two payments and the interest rate is 3.01. So the total payment that you'll be received for that year is about $30.10. And if you hold to maturity until the 10th year, you can see that the interest rate has increased to 3.2. So the interest payment that you'll be receiving for that year is about $32. So if we average out the interest rates, it's about 3.06. And the future earnings, if you hold to maturity, is about $306. So if we divided by 10 years, so it's as if that every year you are receiving about $30.06 for interest payment for your $1,000 of your capital. So it seems like not bad. Okay, but let's say, for example, some people, they say that I need my money right now. So how can I redeem early, or what are the payments that I can possibly earn if I decided to redeem early? So here, there's another example here. So similar, we will use an example that you apply for $1,000 for the SSB. And this is the part where you fill in, this is the bond, always choose the latest bond that you wanted to buy, and then the amount that you decided to invest in. And here you can see that if you hold to maturity, which is the previous example, it will show you the similar graph. But if you decided to redeem early, you have to mention which month and which year. So for here, I decided to put January 2028. So now let's look at the next slide. So assuming for this example, if you decided to redeem early, so you can see that for the first 4 years, you still receive the full payment. But then in January, you see there's a slight decrease. It's because it is prorated. So you only hold for the bond about 4 years to 4 months. Because after September, there's October, November, December, and January. It's a total of 4 months. So the payment for this interest rate is actually prorated. So as such, this is the potential future earnings that you might get if you buy this month's SSB. So if we divided by 4 years and 4 months, so this is roughly what you'll be getting every year for the investment that you put inside the SSB, which is $30.17. So I hope that this is easier for you to decide that, is this a investment vehicle that I should consider to put my extra cash in? And you can play around that. How long should I put, or maybe should I hold it to maturity? Okay, so right now, after we have seen some of the example, you might be thinking that, is SSB really suitable for me? So let's look at some of the pros and cons for it. So first thing of all, SSB is suitable for passive investor. That means I just want to put my money in and let it grow, as if that I'm putting my money inside a bank account. And this is actually another flexible way for you to put your money. So maybe you can put some portion of your money inside a bank account, or maybe some other bonds, like for example, Singapore saving bonds here. And they are actually satisfied with the returns about 2 to 3%, because this is roughly the range that SSB usually offered. Okay, and it's also for low risk appetite. That means I'm afraid of losing my capital because I don't want to take risk for my money. So SSB is another alternative you can consider, because it's fully backed by the government and it has a AAA rating. But for those of you who are much more active investors, that means I want to invest my own money, I want to grow more out of my money, 2 to 3% is not enough for me. So SSB might not be suitable for you. And for these active investors, they are actually willing to spend more time to identify stocks or maybe some other opportunities that can offer higher returns that are much more than 2 to 3%. So for today, later, Yang Zi, which is another of our hosts, and also George will actually share with you that how you can also generate higher returns for your money. So here we are merely sharing with you what are the possible alternatives or investment vehicles that you can consider, but not a stock tips or hot tips for you to decide to go in and get back the returns, because every investment carries certain risks. And definitely for active investors who decided to invest in stocks, there will be definitely risk for all these investments. So that is the reason why we decided to learn more about how we can better invest our money instead of following hot tips. So for this part has ended. So now let's look at what are the rates that we can compare, because it's only when we compare the rates then we will decide whether is this investment vehicle suits my needs and is it what I really wanted. So earlier on, George has done a very detailed explanation on what is inflation. So here I'll just do a quick run through on what is really an inflation. So for example, back in year 2013, if we wanted to buy a basket of groceries, we only need to spend about $150. But as time passes, everything is rising. Fuel is rising, interest rate is rising. So this is known as an inflation. Everything is rising. So back to this year, now from the past, we come back to the present. If we are going to buy the same basket of groceries, instead of spending $150, we have to add in an extra $50 where we have to pay about $200 for the same basket of groceries. So inflation actually decreases our purchasing power. So this is one of the reasons why instead of putting money inside a Milo tin or maybe a very low interest rate savings bank, we should also consider to invest our money so that the money can grow on par with the inflation so that it will not be eroded. Our purchasing power will be retained. Okay, so earlier on, George shows that the word called core inflation, 3.8%. So actually for Singapore inflation rate, there are two types. And this is the latest figure released just a few days ago. So this is the inflation rate back in July. So earlier on, he shows that the core inflation is 3.8%. But then he mentioned that another number that you should take note of is CPI, which is the Consumer Price Index. So here it actually shows at 4.1%. So right now, some of us might be confused that what are the difference between these two numbers. So for CPI, it actually keeps track of the price changes for goods and services that is being bought by public over a period of time. So for here, they actually keep track monthly. So here it means that in the month of July, the CPI inflation rate is about 4.1%. So what are the items that they actually keep track of? Which are these 6 categories: electricity and gas, food, private transport, services, retails and other goods, and also accommodations. So for CPI, they mainly keep track of all these 6 categories. And now for core inflation, the definition that MAS given is that it's based on CPI excludes volatile product prices. So what category are considered as volatile product prices? So they mentioned that it's actually private transport and also accommodation. So they do not include these two. So they only keep track of these 4 categories for core inflation, because they mentioned that it is able to better reflect how the Singapore household expenses more accurately compared to these two. Because some people might not want to take public transport, might not want to take private transport, or they just wanted to take public transport, or there's a very high volatile price changes for accommodation as such. So they keep track of these 4 categories to reflect on what the Singapore household actually really spent. So that's why there's these 2 numbers called core inflation and CPI. Okay, so now let's look at what are the categories that actually influence the drop of the inflation rates. As you can see that inflation rate has been increasing during the COVID period until the height in mid-2022, before right now it's slowly coming back down. So here, I got it from another news channel where they show that, where they separate nicely that these 4 are the core inflation, and including all these 6 are the CPI. So we can see that for these 3 main categories, they actually experience a drop. So that is the reason why core inflation has been decreasing since early 2023. Services still remains the same, And the other two categories, other than the accommodation increase slightly, private road transport also decreases. So this is the reason why the CPI inflation rate, the core inflation rate has been decreasing since 2023. So right now, with that in mind, we roughly know that the inflation rate is about 3.8 to 4.1. So is there any way where can I store my money to beat the inflation rate so that my purchasing power is not being eroded? Okay, so now we will look at the Singapore bank interest rates. So for today, we will be looking into the fixed deposits and also the savings account. Okay, so now for August, the interest rate. Okay, so for fixed deposit, we'll look at mainly 5 banks. So I'll show the first 2 banks that has the highest interest rate as of August, and then also our 3 local banks. So for Maybank, you'll be able to earn a 3.75% of interest rate if you put $20,000 for 12 months, but there's a catch. The catch is that you need to deposit $1,000 into either the current accounts or saving accounts. Then next is followed by CIMB, where they offer 3.55% if you put in $10,000 for 9 months. And the 3 local banks is somewhat slightly lower compared to these 2 higher interest rates, where DBS, you just put in 1,000 for 12 months, you'll be able to gain 3.2%. And UOB and OCBC, they offered similar rates, but you need to put different deposit amounts. So UOB is about 10,000 for 6 months. OCBC is 30,000 for 6 months. So this is the rates that they offered for this month. So every month, every other banks will offer different rates. So you will need to check every month if you are interested to put your money into the bank's fixed deposit. So for the savings interest rates, earlier on, George actually explained that even though the highest, which is right now for StanChart, is about 7.88, looks very attractive. However, if you are to look into the bank's terms and conditions, you realize that you need to at least fulfill all 5 of the criteria in order to get these interest rates. So let's say, for example, StanChart, you need to credit your salary into the bank, into this bank, and then you need to spend a certain amount of money, buy their insurance, invest money into their products. And finally, there's final category, which I can't remember. Maybe some banks, they will say that you need to apply for a loan for your housing or as such. So on each of these banks' website, they actually offered a calculator for you to calculate that if, let's say, I decided to put my money, my salary into this bank, and I spend this much amount of money, how much is the reasonable interest rate will I get? So on their website, you can play around. But here we are just showing that if you are to fulfill all of the criteria that the bank listed out, what are the possible max interest rate that you can get, which StanChart currently stand at the highest at 7.88, followed by UOB at 7.8%, OCBC at 7.65%, DBS is 4.1%, and finally CIMB at 3.5%. So if you are interested to know more that what are the possible interest rate that you can earn from the savings account, you can go to their website, play around their calculator, and see what are the potential interest rate that you can get if you are to put your salary, your money into these savings interest rates. Okay, so of course, we will also look at the CPF interest rate, which does not change a lot other than the Special and MediSave account, where they increased about 0.001% since the previous quarter. So everything remains the same. So 2.5 is also slightly lower than the interest rate as well. But at least the special account beats the inflation rate. Okay. So now we will look into the 3 MAS bonds, which is the Singapore Saving Bonds, the SGS bonds, and also the T-bills. So what are the difference between these 3 bonds? Okay, so here, earlier on, we've shared that it's a flexible investment period where you can save up to 10 years and you collect interest payments regularly 2 times per year. And the minimum amount that you need to put into this bond is 500, and the maximum is about 200K, and the interest rate is step up. So for Singapore SGS bonds and also T-bills, these are their features. They are tradable. That means you can trade it on the SGX. However, do take note that even though it's tradable on the SGX, you may need to take note whether is there any demand that people wanted to buy. Even though you wanted to sell, but if there's no one wants to buy, then it's quite hard for you to get out of the position of these bonds. And another thing is that once you put your money into these bonds, there's no early redemption. The only way out of these bonds is to sell it on the SGX bonds. So this is one of the risks that you have to consider, whether is it liquid for you to sell it off or not. So for SGS bonds, it's actually a long-term bond. So that means the bond is possible for 2 to 50 years, whereas T-bills is a shorter bond. So it's either 6 months or 1 year. So for SGS, the interest payment is also similar to Singapore saving bonds, which is you collect interest payments 2 times per year, yes. But for T-bills, you actually do not collect interest payments. You actually purchase it at a discount upfront. So that means if let's say the interest is about 2%, so you only pay about $98 if you buy it at $100, something like that. Okay, so the minimum amount for these two are similar, which is 1,000, and for SGS bonds is actually a fixed rate. Okay, so now let's look at the rates for these 3 bonds. Okay, so for Singapore saving bonds, earlier on we see that for this month it's about 3.06, and you can still buy it if you're interested for this month. And for SGS, the previous coupon rate, so here coupon rate is actually means that the interest payment that you can potentially receive, which is 2.875%. And the upcoming one, the auction date, that means the closing date for this one is at 29 August. So they will only announce what are the coupon rate for this bond for 2 years. So this one is for 5 years. So that means you have to hold it for the next 5 years. And this one is for the next 2 years. So the coupon rate will only be announced once the auction has been completed. And for T-bills, the previous one is for 6-month T-bills and the cutoff yield. So here for T-bills, they are using a slightly different term called cutoff yield. And cutoff yield is actually the overall annual return that an investor can expect to earn. Because earlier on, T-bills, it mentioned that it does not collect interest payments. So we don't look at coupon rate. It mentions that it pay at an upfront discount. So this is as if the discount. But even though you see that it's 3.73, do take note it's mentioned it's about per annum. So the T-bill is 6 months. This one has to be divided by 2. It's because per annum is 12 months. Okay, so the upcoming one, they only released the cutoff yield on 31st August after the auction has been completed. So this is the yields that is being offered by the MAS bond for this month. Okay, so right now, some of you might be saying that, maybe SSB looks good for me. So how can I buy? Okay, so first thing, you can buy with cash. You can buy it with your SRS funds. And how about CPF? Unfortunately for SSB, you cannot buy it with CPF. Only Singapore government securities, SGS bonds and T-bills, you can buy with CPF funds. But SSB, you can only buy with cash and SRS funds. Okay, so for cash, what you will need? First thing, you will need to have a local bank account from either one of these 3 banks, and you will need a CDP securities account from SGX. So how do you apply for the CDP account? First, you go to the SGX website, and you need to have an account with one of these local banks. Sign up with MyInfo or using their online form, and then send in your supporting document as required on the website. So with that done, then you can use these 2 ways. You can apply the Singapore saving bonds with ATM or via internet banking. And these 2 videos are actually shown on the MAS website, which I will not play for today. You can go to their website and they have these 2 interactive videos where they show you step by step on how you can apply via these 2 methods. So if you wish to buy SSB with cash, first thing you will need is a local bank account and also the CDP account. Then you can go to buy via ATM machine, or you can buy via the internet banking. And next, for the SRS funds. So SRS funds is actually another type of funds where we can save on taxes for retirement. So here, if you decided to put money into SRS account, you actually get a dollar for dollar tax relief. But do take note that you can only have one SRS account. Okay, so what you will need is that you need an SRS account with one of these 3 local banks. So you can either choose DBS or OCBC or UOB to have an SRS account. And from there, you can apply the SSB on the internet banking website. You cannot apply SSB in person at the bank counters. So everything has to be done online. So this is how you can apply for SSB with your SRS funds. Okay, so now here are some of the key details that you can take note of. So who can apply? So for SSB, it is actually applicable for anyone who is above 18 years old, including foreigners. So as long as the foreigners has a local bank account, they can open a CDP account, or maybe they can, or they have an SRS account, then they can buy the SSB. And the investment amount is that minimum 500. And if you wish to increase, it has to be in multiples of 500. And the maximum is 200K. However, do take note that there's a $2 transaction fee for each application. And the issuance frequency is every month. Let's say, for example, this month you cannot purchase the SSB. No worries. They will release another SSB for next month. However, for the rate, you will need to check on next month because each month the rate will be slightly different. Then this is the application timeline. So every month they will announce the new SSB on the first day of the month, and then they will close the application at least 4 days before the month end at 9 p.m. And the next day, then they will say that who will be able to get the SSB because it's by allotment, by balloting. Only then the person who has successfully applied for the SSB, then they will issue it on the next month. So this is the operating hours. So you can apply between 7 a.m. to 9 p.m. from Monday to Saturday for the SSB. So after today, if let's say you're interested in, you can still apply, or maybe you can wait until Monday to apply. And also they exclude public holidays. Okay, so right now you might be thinking, I can get in, but how do I get out? So how you can get out is that you can hold it to maturity. That means you hold it for 10 years. So for this one, there's no action required. So the principal or your money will be automatically credited back into the bank account that is linked to the CDP account for those who are applying via cash or your SRS account. And for those of you who wish to redeem it early, that means I don't want to hold for 10 years. Maybe after 2 years, 3 years, or 5 years, I need my money. So I wanted to redeem early. So you can actually redeem it any month. And there's no penalty. It's only that there's a $2 transaction fee for this redemption request. But if you hold it to maturity, there's no transaction fee. And the requested amount will be credited back to you in full by the second business day of the following month. Does not mean that this month I want to get my money so I can immediately get it. They only credit back to you on the second business day for the next month. So do take note of this. Okay, so what are the channels that you can redeem early? So first thing, for cash, you can apply via ATM or internet banking. And for SRS funds, it's via internet banking. So this is the retention timeline. So you can redeem it any month that you wanted, but do take note that they only release or they only credit back the money back to you by next month. So let's say, for example, you decided to redeem it on 27 August, then MAS will consolidate all of the applications on 28th, and they only release it on the following month, which is 1st September, end of the day. So if you wish to if you have plans to redeem early for your funds, then you have to do some plannings. It does not mean that right now I need my money, I want it now. It does not work that way. They only credit the money back to your account on the next month. Okay, so these are the similar operating hours for the redemption as well. Okay, so to conclude it all, so the pros is that the SSB are fully backed by the Singapore government and it has a AAA rating. So the duration is flexible, so you can redeem any month within a 10-year period with no penalty. However, some cons that you should consider is that if you wanted to have higher returns, it may not be suitable for you, where Yang Zhi and also George will share with you on how you can better grow your money with higher returns. For me, this session is more like a defensive. That means it's good as bank account, or maybe even better than bank accounts, but may not be as good as other potential investment vehicles for higher returns. And you may need to wait till the next month for redemption. So certain plannings will need to be done. It's not like your bank account that right now I put in my ATM card and I can immediately get cash. So you can only get back the money by next month. So with that, I've completed my presentation for today, and I hope that all this information is valuable for you to know what is SFB, so that you can make a better decisions, or where you can better find further information to make a wiser decisions on how to further invest your money or grow your wealth. And with that, I'll pass this session back to George. And George, back to you. George, is it just offline? Okay, give me a moment. Okay, it seems like George.
Right. No worries, Hilary. Or shall I just take over from here since I will be taking on the next segment?
Yeah, because George actually has a slide to introduce you. So maybe I just do a quick introduction.
Sure. Thank you, Hilary.
Yeah. George is, I'm sorry, our next speaker is actually Yang Zi. So he's actually from iFast, where it's very kind of him to actually show up today to share with us more. So for his session, he'll be sharing more on stocks. So we know that stocks definitely can generate much higher returns compared to SSB, but higher returns sometimes may come with higher risk. But if you know what you're doing, then the risk can be minimized. So for today, George will actually share with us one of the companies that he thinks that maybe it's a good opportunity, but it is not a recommendation to buy, sell, or hold, but it's merely share with us that how we can evaluate a company, and then whether you decided whether do you want to learn more on how you can evaluate a company to decide to invest your money. So with that, I'll pass the session to Yang Zi. So maybe Yang Zi can carry on for that, because I do not have the slides to present. Yeah.
Right, sure. Okay, thank you so much, Hilary, for the kind introduction. Well, I think the time is 11:15 now, so I'm kind of caught in a situation where I don't know whether to wish you all good morning or good afternoon. So both good morning and good afternoon to all of you all who are tuning in today. I'm going to share my screen over here. Right, so I think I will not be doing all the visual audio checks and everything, but if any point if you all cannot hear, just feel free to type out in the chat. Okay, right. So let me just start the slideshow. Okay, right, sure. Today I think I'm really inspired by Hilary and George's sharing earlier. In fact, I would even go a step further to argue that Singapore savings bonds, T-bills, these are great ways for you to put your money. In fact, they are much safer than putting it in a bank, because banks can collapse, right? In March of this year, we have seen banks like Credit Suisse, Silicon Valley Bank, big banks that actually collapse. So while they can give you returns of like 3%, 4%, versus the government giving you 3% and 4%, there is absolutely no comparison here. SSB T-bills definitely gives you a better, higher in terms of a risk-return perspective. Right, so today I'm going to share with all of you on a case study of PepsiCo. Right, so this is for some of you who have a slightly high appetite for investing, right? We want high returns. But of course, when we talk about high returns, we want high returns in a very sensible way, right? So today, if we talk about stocks, everyone, if you ask your friends and all, everyone is going to talk about like your AI stocks, your NVIDIA and everything, right? So opportunities are I think there are opportunities everywhere. But today, if you are going to talk about buy into AI stocks, some of the worries would be that are things overpriced, right? That is very scary to be buying into some of these counters. And I personally believe that opportunities are basically where people are actually not looking at, right? So I think what's really more exciting is to talk about this newly minted dividend king, PepsiCo. So what is a dividend king, right? And why does it matter? So this is what I'm going to share with you all in the next few slides. So to start off, this is me, right? So my name is Yang Zi. So I work at iFast, and basically I think you receive education from firms like VIA. For last at iFast, what we do is that we help investors like yourself for implementation. So if you're intending to buy, your T-bills, you don't buy stocks, ETFs, and we are basically a platform that allows you to buy some of these investments, right? So along the way, I put a QR code over there. Along the way, if you have any questions, feel free to just scan the QR, reach out to me with any of your questions, right? So personally, I've been investing for the last 10 years, right? So I've explored strategies from bonds to funds, to stocks, right? In stocks, I explored a lot of different things: value investing, growth investing, technical analysis, momentum, you name it, right? But I was really inspired by George's sharing earlier, right? Investing, end of the day, is not just a number. It's not about just getting the high returns, but it's about how do you invest to help you achieve some of your life goals. So I remember his picture just now of Switzerland, right? So actually, how do you invest in a way that is, in a sensible manner where it can help you achieve that kind of financial freedom, right? So after 10 years of investing, I realized, I tried a lot of very complex strategies, and I realized some of the best investments are the ones that are the simplest. So today we're going to talk about a business that is relatively simple to understand, but is worth looking at, which is PepsiCo. Okay, so this is a disclaimer over here. Oh, okay, the font is a little weird, but basically, this is just to tell you that this is not an advice for you to buy or sell PepsiCo or any investment, okay? Everything that's shared over here is for informational purposes only. The investments that you're about to make is basically varies based on individuals' risk appetite. So if you wish upon to act upon any of the ideas being shared, please do your due diligence or seek advice from professional. Okay, so with that, I'm going to start the sharing proper. So we're going to do a case study into PepsiCo, right? So this is a chart of PepsiCo's performance over the last 5 years. If you realize, PepsiCo gained 58.18% over the last 5 years, beating S&P 500's 50% gain over the last 5 years. But what's also really interesting about PepsiCo is that besides the fact that they are growing faster than S&P 500 over the last 5 years, if you look at where my mouse is, I'm not very sure whether you can see my mouse, but yeah, the mouse over here, you see the dividend yield, right? 2.86% per annum. So today, if you are a more aggressive investor and you are comfortable with short-term volatility, PepsiCo could be a good alternative to your element of bonds, right? So if you prefer certainty, more certainty, you don't want your capital to fluctuate up and down, you can consider things like SSB, and then you get a 3%, right? If you're okay with volatility, you're a more aggressive investor, you can consider even companies like PepsiCo, right? You're going to get around 3% a year, and on top of that, some capital appreciation. Of course, that capital appreciation comes with some risk and some volatility. Okay, so I'm just going to do a very quick introduction on PepsiCo. I think it's almost self-explanatory. So I won't go into a deep dive as to what PepsiCo is doing. But basically what they are, right, is a global beverage and convenient food company with large trusted brands. Okay, so this is taken from their annual reports. This is what they call themselves. So besides the Pepsi Cola that everyone is really familiar with, they also own other beverage brands like 7-Up, Mountain Dew. All these names are actually owned by PepsiCo, right? And then you will realize they don't just do beverage, they do convenient food. So what convenient food really means is that they do snacks. Okay, so they sell snacks. So you see in their whole arsenal over here, these are all the brands, some of the brands that they carry, right? You have your Lay's, Quakers, Ruffles. So today, if you take a trip to the supermarket nearby, you go to NTUC or Sheng Siong, you probably see a lot of PepsiCo's products. And I would even go a step further to say that if you look at home, at least 50% of you would have some PepsiCo products at home. And if you look in the middle over here, you will see Starbucks, right? And then you'll be wondering, hey, is Starbucks owned by PepsiCo, right? The answer is no. So because PepsiCo has been in this bottling business for many, many years, right? And Starbucks is in the business of coffee. So what they do is they have a collaboration where Starbucks sells the coffee, makes the coffee, and PepsiCo actually bottles them. So today, if you go to you go to NTUC and then you see the bottled Starbucks, right? It is actually a collaboration between Starbucks and Pepsi. Okay, moving on. So I said earlier that Pepsi is a dividend king, right? So then the thing is this, right? So what makes a dividend king impressive? What makes a dividend king impressive, and why should we actually even bother about it? So let me just show you Pepsi's impressive track record over the last 10 to 50 years. Okay, but let's start off by answering this question: what is a dividend king? So if you invest in the US stock market, you will hear things like US dividend aristocrats, you hear dividend kings, right? So dividend kings, by definition over here, are stocks that have raised their dividends for at least 50 years, right? 50 years are 50. And so the key thing is here, right? Dividend kings have survived periods of inflation, commodity booms and busts, rising interest rates, recession, market crashes, changing consumer tastes, technology advancements, and more. So what this paragraph here really means is that dividend kings are really strong businesses because they have lasted through the last 50 years. And the last 50 years has not been easy. There will be market crashes, there have been recessions and everything, which I will show in the next slide over here. So this is a chart of the MSCI World over the last, this is, I believe, 40 years, right? So over the last 40 years alone, there were so many financial crises that happened, right? In 2001, we had a dot-com crisis where, everything .com went up. And then, there was so much speculation. And by the end of 2001, a lot of these companies actually, the bubble burst, companies went bankrupt and the economy was in a very bad shape. 2008 was a Lehman Brothers crisis where, one of a very big banks, Lehman Brothers, right, they actually collapsed. They issued out too much bonds and then they collapsed. And that caused kind of a chain effect and the whole global economy went into a recession, right? So 2022 was COVID, right? The world shut down and then trade stopped. Everyone was staying at home and we experienced recession for a short period of time. And 2022, where we experienced the great inflation and a great, very high interest rates, the economy is also slowing down. So it does not. What makes a dividend king really interesting is that it does not matter whether economy is up or down, whether the economy is in a recession. These dividend kings. Yeah, sorry, I think my internet, okay, I think I'm back. Yeah, so these dividend kings continue to increase the dividends across all these difficult time periods. Okay, so I want to illustrate over here, right, that raising dividends is actually not as easy as we think, right? So the fact is that business is difficult, right? So this is some statistics by the US Bureau of Labor Statistics, right? For new businesses, of course, right? In the first 2 years, 20% of all new businesses will fail. Over 5 years, 45% of them will fail. And over 10 years, more than half of businesses will fail, more than 65%. And they, these statistics over different periods of time, they have remained consistent over very long periods of time, which means that businesses is not actually easy for businesses to thrive over long periods of time. Of course, PepsiCo is not a percent of them actually shut down, but over the last 50 years, but they have been increasing their dividends over the last 50 years. And what this tells us about PepsiCo's is that it tells us a lot about PepsiCo's strength, right, in terms of its market position as well as its brand amongst consumers like me and you. So here is the chart of the historical dividend payouts since 2010, right? You see the chart over here, 2010 all the way to 2023. Again, this is taken from the PepsiCo's investor presentation. So you realize the big number over here, 51, right? This basically says that they have been raising their dividends for 51 consecutive years. And I must emphasize consecutive years, which means that despite everything that happened in the world, they have been increasing their dividends consistently every single year. Okay, so if you had bought into PepsiCo stock in 2010, for every one share that you own, PepsiCo will pay you $1.89, right? So instead of buying the Coke, right, you buy the Pepsi Cola, you buy the share. What happens is every share that you own, they pay you $1.89 in 2010. So if you just continue holding that and don't do anything, by 2023, the same one share that you're holding is going to give you $4.95 per share that you hold, right? So, but that's not all, right? PepsiCo has been very shareholder friendly. If you look at the blue box at the bottom, this is what we call the share buybacks or share repurchases. So not only does PepsiCo give out dividends, they do share buybacks. So you see over here, these are all in billions. So 5 billion, 2.5, 1 billion. So a lot across the last 13 years, they have been doing share buybacks. And what share buybacks do for you as an investor, do for us as an investor, is that first thing is that if a company, there's only one reason why you would buy a stock, right? It's because you believe that it will go up. So if the company aggressively buys back its own stock, it shows a conviction in its own business model. It thinks that its business will continue to grow. And the second thing is that basically, if they buy back more shares, it means that there are less shares outstanding. So the value of the shares that investors like me and you hold, the value will actually go up. Okay, so as we know, 2022 has been a very challenging year for the stock market. We have inflation, as mentioned by the first presenter, right? Inflation is all-time high, and to make things worse, interest rate is also very high. So besides having to cope with high inflation, those of us that have properties and all, you realize that your mortgage loan is increasing drastically. If you're paying $1,000, it's $1,500 now. You're paying $2,000, it's like $3,000. You're paying $4,000, it's probably even more, right? So it's been a very challenging year for individuals as well as the stock market. So if you had invested in 2021 or 2022, right, it's quite possible that your portfolio could still be in red, right? And if you are a growth investor, meaning if you buy into some of these very hype names, right? Hype names, there are a lot of very popular names in 2020, right? If you invested in those, the situation could be even worse, right? We see declines of like 70 to 90%, right? But I mentioned earlier that PepsiCo we want high returns, we want reasonable returns, right? In a sensible manner. So I earlier mentioned that PepsiCo is a stable company that you can invest and collect 2.8% dividends while waiting for markets to recover. So let's just see, in a year where everything is so bad, how did PepsiCo do in terms of its stock price as well as its business? Okay, so this is a chart over here that shows, several indices that tracks the performance of several things across a fixed period of time. So we start off from January of 2022 all the way to April of 2023. So for those of you who are not aware, S&P 500 is basically the 500 largest companies. So how do we interpret this blue line? Is that, we hear that S&P 500 has went up. We hear that S&P 500 has went up significantly this year. But if you had invested in S&P 500 on January of 2022 up to today, basically you have not recovered yet, right? Because of the declines experienced in the whole of 2022. So consumer staples, for example, all your like groceries and all, which is the brown line. Sorry, it's not brown, it's purple. I can't tell whether it's brown or purple. But basically the brown or purple line over here is consumer staples, right? Things like your groceries and all. They were doing slightly better than the S&P 500, but again, it's still a slight decline. But if you look at the yellow line, this is PepsiCo on the other hand, right? Actually gave investors a positive 6% return during this time period. It also outperformed this S&P 500 during this time period. And what is the significance, right? Is that today, if I'm an investor in any stock, one of the key things I am really worried about is whether companies I buy, are they able to weather a recession or economic crisis or not? Right. So what we are seeing over here is even in a very terrible year like 2022, you are not only collecting your dividends, but you are getting positive gains on investment in Pepsi Cola. Right. So 2022 turned out much better than expected for PepsiCo. So while a lot of companies, especially, there were a lot of jitters in like tech company and all, right? A lot of companies are seeing their earnings decline significantly. They are revising their guidance downwards. PepsiCo is actually seeing their earnings increase. You see the blue line over here, this is their earnings per share. So if you realize towards the tail end, 2021, 2022, when things are not as rosy, things are getting difficult, earnings per share actually continue to increase. And if you look at the gradient, it's actually accelerating, it's actually going up. So this is very interesting to note. And it's also important for us to, for me to point out that in the yellow bars over here, these are basically earnings beat. So basically, there will be like analysts that kind of like tries to estimate how much Pepsi is going to make that year or that quarter. The management is going to give out some guidance. So that for the last 13 years, PepsiCo has been beating estimates. So what this means is that they have been performing above expectations. But why is this so, right? So the question is that we know the performance, right? PepsiCo did well in 2022. But why is this so? What makes PepsiCo so resilient, right? Even in 2022. So we're going to find out in a bit, so you understand more about its business model. Okay, so here are some reasons why PepsiCo was so resilient. And the first one is basically that COVID has created more snacking habits amongst households. If you look at this chart over here, two bar charts, right? 2013 versus 2021, right? So a survey was being done, right? In the purple bar over here, percentage of consumer who snack actually increased by 8% from 2013 to 2021, meaning that, because of COVID, right, nowadays people snack a lot more at home. In the yellow bar over here, this is average number of food snacks consumed per day. So it's largely, it didn't change significantly, increased just by a small amount. Again, I mean, these are some statistics. We're not able to verify how they did this survey and how accurate this data is. But if I were to look into my own habits, I would say that this is largely true. After COVID, I think I have this tendency to be snacking a little bit more, having a bit more snacks at home than before COVID. And reason number two, right, so I explained earlier that 2022 was basically a very difficult year for the stock market, individuals and businesses around the world. So what this means is that consumers around the world are actually tightening their pockets, meaning to say that, when 2020-21, there was a lot of free, easy money floating around, people were spending like crazy. But when it comes to 2022, 2023, people start to become very conscious, like, wow, if I want to buy property, I better be a bit more careful, right? When I buy things, I want to spend money, I better be more careful because everything's very expensive and my loans are getting very high. Right, so during this period of time, people want value for money kind of food, right? So instead of eating at, let's say, high-end restaurants, we're going to have a lot more hawker meals than just high-end restaurants. And typically, more people will prefer to save money, right? To prefer eating at home than eating outside, right? So these two trends generally benefit PepsiCo because if you're going to eat at home, you're going to buy their products and then you're going to have some of these snacks at home. So the table over here basically tells us that this is a very important thing called pricing power. So what I explored earlier was just trends, right? So trends of how consumers' trends started to change. But we also want to talk about pricing power, one of the key things that PepsiCo has, right? So there are three categories over here, right? There are carbonated soft drinks, sports drinks, and snacks. So in terms of soft drinks, PepsiCo actually owns brands like Pepsi, Mountain Dew, 7-Up. So they own 25% of the entire global market share, right? This is right behind Coca-Cola and the top three players are basically Coca-Cola, PepsiCo, as well as Unilever. and muscle milk. So there are also very few main players in this. There are very few main players in this area. PepsiCo owns 25% of the global share of all these sports drinks, and in US they are even more dominant. They own 67% of all the sports drinks, a market share of sports drinks in the US. And in terms of snacks, right, your Lay's, Doritos, etc., all the potato chips and all, the snack market is something that is very fragmented, meaning to say that there are many small players, right? There are a lot of different snack brands, small brands, and everything. So PepsiCo is one of the top 5 largest players within the snack market, owning over 5 to 10% of the entire market share. So what does this mean? What does this really mean to us as investors, right? Is that because of their dominance in the market, they can actually pass on costs. They can actually have their pricing power. They can increase their prices and all, and pass on costs to consumers easily, right? Of course, that is the theory, right? Let's look at the data to see whether this is true, right? Our assumption is because they have big market share, that means that, you know, they can increase prices and people will still buy. But is it true? So let's look at the data. Let's look at the data over here, what happened in 2022. Now, some of you must be thinking, you know, if things are going to become more expensive, then in the yellow bars over here, this is price increase. Price increase. We realize, you know, the prices of Pepsi products increased, right? We see as high as like Asia, we are a bit more lucky, plus 6% only. So our snacks haven't increased so much, right? But despite the price increase, so you realize, you know, the prices of snack increased drastically last year. But despite this price increase, how are the sales? You look at the purple bar over here, that's volume, right? Besides, you know, these two declines over here, -3% and -7% in Latin America, you will realize that across all other regions, it is actually 0 or positive number. So what does this actually mean? Is that despite PepsiCo increasing their prices, people still continue to buy more of their snacks and more of their drinks, right? So this is a sign of a very strong a business with a very strong and very sticky kind of a product that people continue to buy. So I mean, the closest example that I can think of, it's a bit like you know, like Apple, right? Over the many years, they have issued so many different phones, iPhones, and actually, I'm not an iPhone user, so I'm not exactly very familiar, but you know, the iPhones look relatively similar to me over the many years, right? But one thing that changed a lot is not the iPhone, but the price. It was from a very cheap price, then all the way up to the recent, I think iPhone 13 or something, then the price was insanely high. But people continue buying, right? So that is the power of having a dominant share and having pricing power. So this is what we are seeing based on the data. This is not just our assumption. This is what the data is showing, that PepsiCo has this pricing power. So now, I explained a lot about PepsiCo being, you know, a resilient company. They did well in 2022. So as an investor, then you'll be thinking, right? Should I consider PepsiCo, including PepsiCo, in my portfolio? So I'm not gonna, you know, make any you know, judgments on that, right? But I'm going to refer to the legendary investor Warren Buffett, what he says, right? So what he says is, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So what is saying over here is that there are 2 key things we want to look at when buying a stock, right? When you are investing in the stock, you're actually investing into business, right? You need to know that, is it a wonderful company? Second thing, is it a fair price? So this is a very simple statement, but it's very powerful, because you think about it today. If you want to buy into things like you know, some of your very exciting stocks are like Nvidia, right? Is it a wonderful company? Absolutely, right? It's a wonderful company. But the question is this: are you buying it at a fair price? I don't know about it, right? So let's explore based on this what PepsiCo looks like. So these are 4 criteria not set by me. It's actually set by Warren Buffett, right? So he actually says that, you know, what makes a wonderful company? 4 things to take note of of course, this is maybe an oversimplification, but for the purposes of today's discussion, is to let us just have an idea. First, are they understandable, right? You know, we can talk about a lot of wonderful companies that can do wonderful things, but as an investor, today I'm investing in a business. Can I understand this business? Right. So in the case of PepsiCo, it's not too difficult to understand, right? So I gave it a tick, right? Basically, they manufacture snacks, they sell snacks, their snacks are good to eat, people buy, people enjoy, right? So it's a very understandable business. So that is check. Second, they have good return on capital, right? So this one I'll show in the numbers in the next slide. The third one, they see profits in cash. So meaning to say that these companies are cash cows. And in the case of PepsiCo, this is definitely a tick, because if you look at how they managed to attain the status of dividend king, that is because they have a lot of their profits in cash, right? And not only that, they're doing a lot of massive cash buybacks, right, in the billions every year. This basically shows us that PepsiCo has a lot of profits in cash, right? And the last one, they have freedom to raise prices. Of course, we can have a lot of assessments, look at trends, and then guess whether a company has pricing power or not, right? We can make our guesses. But what we have just seen just now in the charts is that the data is showing that yes, PepsiCo actually has pricing power. Despite increasing prices, people are still buying their chips, still buying their drinks. Okay, so this is a check as well. So then those are more qualitative kind of assessments, right? So just look at some of the very quickly, right, without really diving into the annual statement. I think it's not possible to cover in like 30 minutes. Some just quick overview. Return on equity 53.69%, which is it's amazing basically, right? Anything above 20% is considered good, right? 5-year revenue growth, which means their revenue basically translate to sales. So over the 5 years, has their sales been increasing? Yes, it's been increasing by 6.34% per annum. So that's reasonable for a mature company, right? You don't expect a mature company to increase their sales by like 100% a year. Not possible. That is probably more for a new startup or a new small company. And then the third line, 5-year net income growth, right? It's a plus 13% per annum. But does the company actually bring in any net income or not? Net income is basically your revenue minus all expenses, right? So it's positive 13%. So basically, it's just to tell you that PepsiCo is increasingly more and more profitable, and that results in the last line number 4 over there, 5-year earnings per share growth plus 13.69%, right? So this is per annum. This is annualized, okay? So the EPS growth per year has been going up by 13.69%. So as an investor, right, this is important because over the long run, in the short term, there are a lot of things that can affect a stock. Is this EPS, earnings per share? If a company's EPS can go up, its share price can go up, right? If its EPS is stagnant or is not able to grow, then we cannot expect the stock price to go up. Then the second question we have over here, right? We ascertain that it's a relatively good company, but if we're going to invest in PepsiCo today, is it a fair price, right? So without going through very complicated DCFs, things like that, I just take a very quick snapshot of some of the valuation ratios, right? Which is a P ratio. So over here, there are 3 ratios: the current P ratio, the forward P ratio, and 5-year average P ratio. What does this really mean? Current P ratio is at 31 times. So current P ratio means the P ratio today, right? What is it trading at 31 times? Basically, P ratio, the higher it is, the more expensive, the lower it is, the cheaper it is. Forward P ratio basically refers to the fact, the kind of a projection of where the P will be based in 12 months' time if the price remains where it is today. So if we see forward P ratio is below the current P ratio, it's basically saying that the expectation is in the next 12 months, earnings of PepsiCo is going to increase. So, PE is a result of 2 things, right? Price and earnings. So if the price remains the same, earnings go up, the ratio goes down. Okay, so I understand it can be a bit complex, so I This session is not intended to explain this, but basically what it goes to show is that expectation is that PepsiCo's earnings are going to go up over the next 12 months. If you compare the 5-year average P ratio, meaning that over the last 5 years, what is the level that PepsiCo has been trading on, right? It has been on a 25.711 times. So you compare it to the current P ratio, which is now 31 times. It means that today, if you're buying PepsiCo, it's slightly higher than its 5-year average, meaning slightly more expensive than its 5-year average, right? So the assessment over here is that is it cheap to buy PepsiCo now? Not really. Is it expensive to buy PepsiCo now? Also not really, right? So the price is relatively within the fair range, right? Just a quick assessment over here. Okay, I think I've come to the end of my sharing. I think there are some questions. Yeah, I think there are some questions. I'll take some. Yeah, apologies for the internet connection. Apologies for the internet connection. So I see some of the questions over here. Yes, I think regardless of the economy, people need to snack. This is definitely true, right? Can I compare between Pepsi and Coca-Cola? Oh, definitely, right? So to answer Iguan's question, right? If I look at, I mean, I don't have the data over here. I don't have the data over here on the screen, but I actually had a look of a comparison of Coca-Cola versus Pepsi. If you just look at the numbers, on the surface, Coca-Cola, the numbers actually look better. But the interesting thing, there are also two interesting things that I realized. The first one is basically, if you look at Coca-Cola's last 5-year return is about 35%. Pepsi-Cola's return is 58%. And so the first question we need to ask is like, actually, if the financials are doing a lot better, right? If you look at just the financial numbers, it's a lot better, right? Why is it that Pepsi's share price is really moving faster than Coca-Cola? The second question to ask, right, is I look at Coca-Cola's valuation. So historically, Coca-Cola has been priced more expensive than Pepsi-Cola. So usually, if the valuation is higher, right, it kind of dictates that it's kind of the way that market is trying to say that Coca-Cola is more valuable than Pepsi, right? But in recent years, PepsiCo's valuation it actually started to become more expensive than Coca-Cola, right? So to really answer some of your question of this comparison between Coca-Cola and PepsiCo, we have to really look beyond the numbers to understand some of these qualitative aspects of the business, because it seems to me that the numbers are saying that Coca-Cola, in terms of financials, they are a bit more profitable than Pepsi-Cola. But if you look at some other things, right, compare some of the things that are happening in the market, it seems to tell me that there are some qualitative advantages that Pepsi has over Coca-Cola that we may not be able to just understand based on looking at some of these numbers. We have to really deep dive into their individual annual statements to understand their business model. Okay. Okay, Jennifer asked, would you classify PepsiCo as a defense stock? Right, what is the percentage? Right, so I would say, yes, I think PepsiCo is a defensive stock, something that if you are, so I think there are different types of investors, right? If you are looking for, faster growth, I think there are some ETFs that George would be explaining to you later. If you are kind of more defensive investors, you just want some steady growth, you want some dividends, some income and all, I think PepsiCo will classify as a defensive stock, right? Right, I think there are some other questions, but I think in the interest of time, we may not be, because some of these are more technical questions, so it will take some time to explain. So I appreciate all the questions. I left my QR code over here. If you if you have any questions, just feel free to reach out to me. I will try my best to explain them over to you. So I'm going to end my time over here by saying that 2022 has been a very interesting year. If you need help with stocks and all, I think VIA has many good resources that you can look for. And if you're looking for implementation, meaning that you want to buy the stocks, right, or you want to buy things like your bonds, right, where do you actually look for iFast, we actually provide this platform to help you implement some of these strategies, right? So if you need help with existing portfolio, you want to buy anything, right? Feel free to just reach out to me, right?
Fantastic.
Okay, I think I'll end my time here. Thanks a lot. I'll hand the time back over to you, George.
Thank you so much, Wengzi.
Thank you.
It's been a very educational presentation. I do apologize for being out of connection earlier on, but I think you've covered pretty much everything that needed to be covered, which is great. And I found the presentation fascinating because of the fact that we're talking about Dividend Kings. We're talking about a company that basically perhaps a lot of people are not really considering it. And I think it's a great example of investment in a sense that sometimes opportunities and investment advantages that we can create, they're sometimes just in front of us, just under our nose. And as you mentioned earlier, with regards to microchips and exciting sort of stocks at the moment that they seem to be in the headlines, attracts a lot of people and gets a lot of noise because it sounds exciting and sexy. But in reality, going into sometimes boring stocks like, PepsiCo or Coca-Cola, or stocks that basically most people know, understand, it can provide significant advantages. And as you fantastically shown us, it's a great example of really, taking advantage of something that everybody knows and can really sort of make a difference. So thank you very much for this. Thank you for your presentation. It was very good. You've covered pretty much everything. I was looking at the comments that were happening, that were coming in, and you've covered most of them. And as you rightly said, we don't want to get too technical at this particular stage. For all of you who want to reach out to Yang Zi, he had his QR code in there that you can guys scan and go to iFast and connect and basically reach out for any further information. So that has been sort of great in terms of covering some very interesting subjects today, and I'm very happy that we are going into the space of providing you with significant information around your investment journey. So I know that Hilary sort of covered the Singapore government bonds, and it has been a great sort of way to commence this whole discussion we're having today. We went into understanding that, instead of leaving our money into a bank, it's much better to invest in a bond, particularly a bond which is guaranteed by the Singapore government. And I know that some of you guys might be thinking that this is not necessarily sort of that exciting, but I can tell you in a lot of parts of the world that similar schemes are launched or exist. They're not they are not necessarily sort of providing the flexibility that these bonds in Singapore provide. And in most cases, they don't necessarily provide the guarantee that a AAA rating bond provides with the backing of the Singapore government. So it is important to say that, these are fantastic sort of benefits. And frankly, the instrument was created by the Singapore government in the first place in 2015, if I'm not mistaken, for the purpose of the average investor, you and me, in terms of doing something further than just leaving the money in the bank, which, as we've seen with Hilary's presentation, in most times to get a slightly better return, not a fantastic return, but a slightly better return, requires a lot of effort, requires a lot of sort of parameters to be fulfilled, because frankly, banks are not there to give us money. Banks are not there as philanthropic institutions, and so it's not an easy concept. Now with Yang Zi, we've seen something about the stocks, which is very, very interesting, and the return on investment, as well as identifying stocks. I think he showed us some very interesting components in relation to some criteria that they play an important factor as investors in our journey. PE ratios and other parameters that effectively is exactly developing the investment journey are something that we've seen in action in identifying and analyzing a stock. And frankly, these are the parameters, and this is the process, if you like, that needs to be undertaken in terms of selecting a stock, because a lot of people that they don't understand investing and they just jump into the space because somebody else told them about it, they will never, in most cases, undertake anything similar to the analysis that Yang Zi has given us, which is really fantastic. So this is the second part of the seminar today. And for the remaining part of the presentation, we're just approaching around 12 o'clock in Singapore. I'll be covering the passive investment component, which is basically a large portion sometimes of our investment journey, which you can see here, and effectively considers something that we'll learn, we'll understand, which is called ETFs, exchange traded funds. And in that particular case, having understood and done certain things, such as putting money in the bank and saving money to start with, investing in bonds perhaps, maximizing our CPF, and understanding how we can invest in stocks in a better fashion for higher returns, will allow us to have a collective approach as investors and maximize our return on investment and allow us to have the lifestyle we want. So basically, moving on to my part of the presentation, which is coming up just now, and maybe just a few words about myself. I am a VIA graduate, and I'm also a trainer in VIA. I'm originally from Greece. I was born in Greece in Europe, and I've spent a lot of time, pretty much most of my life overseas. And I have been in Singapore for 15 years. So value investing was something that attracted me through Caden and the whole group of people who've been sharing information a few years back, and I've attended the courses that Caden sort of offers, and effectively I was happy to adopt a very interesting investment approach, which I'm here today to share with you. And for various different sort of reasons, I've managed to sort of move on in my journey, and I'm no longer in Singapore, but I will certainly come down to Singapore at some stage. And I do apologize, as a matter of fact, for the bad connection and everything, because I am actually dialing in from Switzerland. I am in Geneva in Switzerland. So back into the presentation slide that I was showing you earlier with the beautiful Alps and the lakes, I am actually very close to that location. It's the Mont Blanc in Geneva. And I'm happy to be broadcasting from here, but I do apologize for sometimes the awkward internet connection we have. And what I'm here to talk to you about today is effectively ETFs, and basically a way, together with what we've learned today through Hillary and Yang Zi, that will allow us to get a higher return, and how we can actually do it in a simple way. Because many times, as Yang Zi said, there's all sorts of numbers, there's all sorts of formulation of parameters and calculations. People get lost, and even the language that the financial industry uses could be quite intimidating and confusing for somebody who starts the journey in the beginning. So it is important to have someone like Value Investing Academy who takes you through the process and effectively guides you in all these technicalities and difficulty. Frankly, having seen that process and understood from somebody like Value Investing Academy, you realize that it's not really as difficult and as complicated and as time-consuming as it seems, or as people advertise investing to be. It doesn't have to be. And it's most of the times something that you just set it and forget it, something that you can just allocate a little bit of your time to that process, and then you see your money grow with time. Now, before we get into this, just like the other presenters today, I just need to put the disclaimer notice up there because of the fact that Mind Kinesis Investment is not operated by a broker or a dealer or a registered investment advisor. We're not here to tell you to buy this or sell that or do the other. We are basically here to educate, to share information with you in terms of what we understand as investors, but it's not intended, the presentation and the content of what we're talking about, Hillary, Yang Zi, myself, is not intended to be or constitutes any solicitation for investment or recommendation. And we don't say this lightly, not just only because, you know, there's a legal consideration here, but because we truly care for your money and we want you to understand what you're doing. We don't want you to sort of go blindly into some investment that looks like exciting, but you don't really know what it's all about. And then you find out later on that you lose your money. So you have to be quite careful in terms of understanding what you do in this space of the investment world. It doesn't require a PhD. It doesn't require you to be ultra wealthy or ultra experienced and clever, but it requires you to spend some time to understand some of the fundamental things. And in a sense, what we've shared with you so far today and what I'm about to share with you with ETFs gives you that sort of first start in relation to the investment journey. So you have a better understanding and more confidence in what you're doing. So when you go ahead and invest, brain rather than just hoping, rather than just guessing effectively. So that's the sort of approach we're taking. Now, before we go into the presentation I'm about to cover, let's look a little bit about this list, which frankly, it keeps changing every 6 months or a year. I think annually they sort of update it based on the money that the wealthiest people in the world have. And you see some names here that perhaps you know: Elon Musk, Jeff Bezos, Bill Gates, Warren Buffett, Gautam Adani in India these days, Larry Page. Now, the interesting thing with this list, if you like, is that it gets updated every year. But frankly, a lot of the names that you see, they either sort of go on top or they recycle amongst themselves. So number one becomes number three becomes number five, and so on and so forth. But these are the people, and the richest people in the world, that they stay up there. They either sometimes increase their wealth by a significant amount, some other times they drop a little bit, or maybe somebody else has made it a bit more. But in general sense, these guys are these people that we see on the screen most of the time. And one of the interesting components, one of the interesting criteria, if you like, to make it into this list, to become a very rich, these are the richest people in the world, is to be a business owner. If you see Elon Musk, he has his own business with SpaceX and other ventures. Jeff Bezos, you probably know him from Amazon. Bill Gates, you know him from IBM. Microsoft. Warren Buffett has his own business as well, which we're going to talk about in a minute. So you can either become a business owner by starting your own business and doing well and expanding, and eventually with time, just like these individuals, you can make it to the top of the list and become one of the richest people in the world. That's one method. Okay, so you start your business and hopefully things are going to work out and you develop the next Amazon. Or, as in the case of Warren Buffett, that we will cover in a minute because it will give us the segue for what we wanted to discuss, you don't have to set up your own business as in a product, as in a service, but instead you can invest in other businesses. This is how Warren Buffett does it, or started doing it, with his company Berkshire Hathaway since 1962, I think, 61. And effectively, or even earlier, I think 1957. Anyway, he's been doing it for almost 60, 70 years now. But he doesn't build any products. He doesn't build any cars. He doesn't transport anything to your home like Amazon does and other companies. He invests in companies that they offer these services and effectively benefits from that. So it's a very interesting business approach. You don't have to reinvent the wheel and create something which is completely new. And we have a lot to learn from Warren Buffett. And we as investors, we always look up to him because A, he's been around for forever. B, he has applied a value investing principle and methodology that we want to adopt as well. And effectively is something that is not just him that did it, but it is a method that has been around for more than 100 years. So his advice, as far as what can we do as investors in terms of putting our hard-earned money into some sort of allocation and make more, comes into something like this. Let me just share something interesting here, because it's much better for Warren himself to say that rather than me trying to explain it to you. So let me try to play this video for you. A slight problem here, guys. Just bear with me for a minute. See if it works.
Systemly. Buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin. The temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And since that century has ended, it's more or less doubled again. The trick is not to pick the right company. Most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
Okay. So that was Warren Buffett himself sort of basically explaining the whole process, explaining how it really works with regards to the allocation of capital you can make. So what he famously said, and what he covered in the video just a minute ago, is that you have to put 10% of your cash in short-term government bonds. So, and I'm just going to underline this, is earlier on we talked about the SSBs, the Singapore Saving Bond bonds. So in our case, saying that I have some problems with my volume again. Apologies for this, guys. Just try. Okay, could you please type in 1 if you hear me and see me okay? Okay, so a few people. Okay, thank you so much, guys. Okay. Yeah, I'm just getting a little bit nervous with the internet connection because it's a bit playing up at the moment. Okay. So, let's go back into this and just repeat it again, because we have to break down the whole process in terms of what he actually said. So put 10% of the cash in short-term government bonds. Okay, so let's go into this one, short-term government bonds. So in our case, as far as Singapore is concerned, we could invest in America, because obviously Warren Buffett is based in America. But in our case, we have an easier and more suitable sort of way of investing in Singapore with SSBs, the Singapore Saving Bonds that Hillary has covered. So 10% of our cash that we have saved, we put it into the Singapore Saving Bonds, a government bond, a short term, okay? In our case, it's not short term, it's a 10-year bond, but frankly, we can redeem it, as we've seen from Hillary, whenever we want to. So it could qualify as a short term in that parameter. And then, excuse me, he says 90% of our money, we need to put it in a very low cost S&P 500 index fund. Okay, S&P 500 index fund. And obviously during the video presentation, during the video that I shared where he's talking about this whole approach, he's talking about thick and thin. So basically talking about when times are good, you invest in that fund. When times are bad, you invest in that fund in an equal fashion. You don't skip. You don't basically say that, oh, this year looks a little bit weird. I don't really like it. Let me just put money aside and not invest in a fund. It's through thick and thin. Okay. So what I'm going to do is I'm going to try to break down and explain what is an index to start with. Okay. So we need to understand what is an index. Then we need to understand what is an S&P 500 index. Then we need to understand what is an S&P 500 index fund. And then what is a very low cost S&P 500 index fund to put it all together, which is a mouthful, but it's important for us to understand what he said in a very sort of casual way, which needs to be broken down for us to the average investor to understand what can we do with this information. So let's go and understand what is an index. Okay, that's the first sort of point we need to sort of assess. Now, what is an index? If I had to explain this to a 5-year-old kid, I would actually use the example of a list. I would actually use the example of cars. Let's say that I like cars and I want to understand which are the best 10 cars in the world or best 5 cars in the world. Of course, you have to define the criteria. What is it? Is it a fast car? Is it the energy consumption, the fuel consumption? Is it the style? Is it how expensive they are? Irrespective of the criteria you define, the idea is to develop a list. Okay, that list could say number 1 is Ferrari, number 2 is BMW, number 3 is Mercedes, and anything else that you like from the world of cars. And by doing that, you created a list. Now, that list is effectively similar to an index because effectively consolidates something of a criteria, which is one of the largest components, and then puts it together. So let's look at it from the financial perspective. Now, this is a picture of one of the floors in the States where is a stock exchange. Now, what is a stock exchange? A stock exchange is a place where you exchange your stock. So physically, you could take your stock to that exchange and go to somebody and say, hey, I just want to sell this to you. So you exchange, you buy and sell. Okay, these are stock exchanges. In Singapore, we have one, which we'll see in a minute. In the United States, they have many. At the moment, they have about 13, if I'm not mistaken. That's 13 exchanges. And in these exchanges, in these stock exchanges, they have all sorts of companies that they trade, okay? All sorts of stocks that they trade because a stock represents a company. So once you have these stocks, people in these exchanges can buy them and sell them, right? So when they actually sort of did all that, they realized that they wanted to assess what the stock market does in a particular state. So in this case, you see McDonald's, you see Microsoft, you see big companies that everybody knows or has heard of. Now, the idea here is many years ago when these indexes were created, economic finance people were saying, I want to understand what the market is doing. I'm not interested just in McDonald's or Microsoft, but I'm interested in the market. I want to see whether the market goes up or whether the market goes down. And if I knew this information, maybe I'll take advantage and make money because I know where things are headed. And frankly, something that most of the people in the financial space, they actually do on a regular basis is they try to predict. They try to understand what's going to happen next. That's why they're all glued to the screens that you can see on your slide here. And we all know that predicting the future is quite difficult. And I don't think we've met anybody yet who has successfully and consistently done it. So predicting is a tough art, tough skill. But people like to do that because they think that if they know where things are going to go in the future, they can take advantage of this. And that's how this whole thing with the index started. So what did they do? The economists said, why don't we just take the largest companies that they are traded in this particular exchange, and we put them in the basket, in a list, as I've mentioned earlier, okay? And say, these are the 20 largest stocks. So we have a list of 20 largest stocks in that particular exchange, or a list of 500 stocks in that particular exchange, or a list of 225 stocks, right? And basically, they take so these are all the companies that perhaps are in the market, but you take the largest ones, okay? The ones that they are having the largest impact on the market. And you can do it by selecting the industries that they operate at. And as Yang Ji was saying earlier about consumer staples in PepsiCo and discretionary. Sorry, the idea here is that you can go on a industry by industry. So the stock exchange has got industry sectors because these companies, some of these companies, they produce similar products or they offer similar services, and effectively, once they have this sort of common denominator, they can be put into the same industry. So an industry, for example, could be healthcare. Okay, so Pfizer and AstraZeneca, for example, are companies that they are operating in the industry of healthcare. Now, the economists will take the largest companies of these industries and put them in a basket and say, okay, these 3, 4, 5 companies from this industry, they go into the basket. Okay, and there are 11 sectors in the United States as far as industries are concerned. There are 11 industries. There's healthcare, there's telecommunications, there is consumer discretionary, there is IT, and so on and so forth. So from these sectors, you take the largest companies and you put them into a basically basket, okay, an index, which is what we're talking about here. So you take them the average price of you sum the prices of all these entities, all these stocks, and then you divide them by the average, and you have a number. So that number represents the overall average of the basket that you created. Okay, so you had like 500 stocks. You can create the average of these 500 stocks, and then you say whether the market is headed up or down. Obviously, you need to do this all the time. You need to do this maybe every 5 minutes or every 30 minutes, every day, every week. So obviously you need to update the prices to see what is the price today or right now in relation to the price yesterday or the time before. Is it higher or is it lower? Now, if it's higher, people say the market is bullish. It's bullish because when you look at this animal here called the bull, they have his horns. And normally what he does with his horns when he attacks is he points and moves things upwards. So up with the horns, it's a bull market because the prices have started from a lower position and they go to a higher one. All right. Now, on the other side, when the prices are showing that they are declining, then people refer to that as a bear market, okay, as a bear condition, because the price before used to be higher and now the price is coming down, and effectively you can see the difference between the two. And it's called a bear because the animal bear normally when he attacks with the paws, and what it does is it hits from the top to the bottom. So it shows the movement where price is from above, they're coming down, versus from the bull that they go from below up. So these are the terminology that people in the market use casually, whether the market is up or whether the market is down. And that is effectively how they qualify or they justify what they can do. But they need the indicator, as we talked about. They need to know what is generally the market doing. Because you got to remember, a lot of these exchanges that have been formulated over the years, they started with a few companies, but over time, they have an enormous amount of stocks. Some of them, they can have like as many as 10,000, 20,000 stocks, right? So you need an indicator. You need to know how the market is headed. So that indicator is effectively the number we talked about. So you take the stock prices of the big companies, you average them out, and then you divide them by the number you have in there, and then you have the average stock price. Now, the average stock price is effectively something that tells you whether the market is up or whether the market is down. So the average stock price is up, so it's a bull market. If the average stock price is down, it's a bear market. Now, the problem with the financial world, guys, is that if you left it there and you said this is the average stock price, it wouldn't sound too exciting and too sophisticated and too intelligent. So people said, you know what? We're not going to call it average stock price. We're going to call it an index. So an index is what? Is a mathematical equation where it takes the prices of the big companies, averages them out, and then compares them with the past to say whether the market is going up or is going down. That's an index, okay? So every exchange in the world, and most of the countries nowadays, they have exchanges, they have an index. Now, indexes are different. depending on the exchange that you are looking at or operating in. So the different country indices, because every country has its own exchange. So in Singapore, we have the Straits Times Index, the STI, which is from Singapore. So this market, this exchange, the Straits Times, has an index, which again is the average price of the largest 30 companies, which in Singapore we call them blue chips, the largest companies that operate in the exchange in Singapore. We also have the Standard & Poor's 500, which we're going to talk about. And the interesting thing with the terminology here is that it almost gives it away as to how many stocks does the index take into account. And in this particular case, it's 500. That's why it's called S&P 500. And S&P 500, as you all know, it's an index that is used to assess the US economy. And most times is watched by everybody, because if the US economy is unwell, then the global economy is also unwell. So it's very important for whatever happens all around the world in terms of the markets. There's also other sort of indices that perhaps are closer to home, like Hang Seng Index, which is from Hong Kong. And in this particular case, the index is formulated by taking into account the largest 50 companies in Hong Kong. There's Nikkei 225. Nikkei 225, again, even if we don't know where that index is from, it certainly tells us something in the name as to how many stocks does it take into account in the calculation, and that is 225. So 225 stocks. That is the Japanese index. Now, the interesting thing about the index is that index, as we've seen, is a calculation of prices, okay? So an index fund is something different because we cannot invest in an index. An index is a mathematical equation we've seen. So we can't really go into it. Now, when the indexes were created, a lot of people who have been in the markets, they said, hang on a minute, I have clients' money here and I want to invest it in the market. I can pull that money. And what I could do is I could buy the shares of the companies that they are included in the index that the people are calculating as to whether it goes up or down. So effectively, they've created a mirror of that index by buying the stocks that they are part of the index that the calculation is made. And that is the index fund. It's a fund because it pulls the money and allows the people who participate buy the stocks of the companies that they are in the index, the largest stocks that they are covered in an index. So with an index fund, you can actually invest and mirror what the market is doing. With an index, you just have a number that says whether it's going up or down, and then you make an assessment as to whether the market is up or down. That's all there is. But you can't invest in an index. Let's be clear about it. So the way to do it is effectively to take the funds of the available, to take the funds of people who have pulled them together and model this index shamelessly and say, if there's Apple stock in that index, I'll buy Apple stock. If there's NVIDIA stock in that index, I'll buy NVIDIA stock, and so on and so forth. Okay, so that's the index fund. Okay, now when the index goes up, okay, as we've seen, the calculation on a regular basis shows that the prices now are larger than the ones before, then the fund itself, because it mirrors the index, also goes up. But when the index goes down, and it does go down, as we all know, we have periods of bear and bullish conditions, the fund also goes down, okay? So we need to be mindful of that behavior because they work in parallel or they work together because the fund mirrors or does exactly what the index is doing. So once again, just to be absolutely clear, index is the calculation of the market conditions by taking the average prices of the largest companies that the index is considering and giving you an indication in relation to the conditions as to whether it's up or down. But when you put the fund together, when you actually put money to mirror what that index considers, you have the index fund. Now, many times people use, instead of index fund, the word ETF. You'll hear this being mentioned many times and casually by everyone. And ETF stands for Exchange Traded Fund, which effectively is a fund which is trading via the exchange. That's all there is to it. So an index is a calculation, a fund, an index fund is the ability for us to sort of invest in that index. And that's what we're trying to sort of do by mirroring the behavior of the market. That's all there is. Index fund is the same as the ETF. Of course, index funds are different. Depends on the country, depends on the type. There's so many index funds these days, you can make your head spin and still not be able to understand how many and what. I think there are probably about 5, maybe 6,000 index fund ETFs available in the market. So you can get lost in the space. Now, if we look at the ETFs in relation to the country indices, okay, so we talked about Japan, we talked about Singapore, we talked about the US, we'll realize that not all ETFs are the same, which basically means that they don't all behave the same. They do mirror the index that they are tracking, but that's not necessarily that index they're tracking always does the same thing as the index in the other country. And a typical example of this is the Japan's Nikkei 225. Now, this is a very long chart, as you can see here, which starts all the way back from the 1960s. And what has taken place in that particular case is that it was a very quiet market for a very long time. And around about the 80s, as you can see here, 1976, but really it was like around the 80s in this location, the market started to slowly move up. And basically what it did is they did an enormous jump up, okay? And in 1990, it sort of reached the peaks, as you can see here, or the peak of its condition. And ever since, that market has collapsed. And for a very long period of time, it has actually gone nowhere. So if you look at effectively the range that this ETF has been trading at is been fairly constrained, as I'm showing you here, but it has never gone up to the levels that we've seen before. So it's one of those cases where what goes up does come down, but it doesn't necessarily mean that it's going to go back up again. Okay, so it's a typical example of somebody who invested in an ETF in a particular sort of space, in this case in Japan, thinking that they can make money, and they could have made money if they started early. But if someone, and most of the times most of us could do that, is effectively investing at a space where, you know, we could go at the top, like up here, and then we lose our money. And if we're not careful and we don't know what we're doing, and we haven't investigated that particular index, we could wait for a very, very long time for that price to come back again and maybe break even or maybe make a little bit of money. So let's talk about the possible return on investment in the ETFs that we consider as suitable for us to invest as value investors. So let's stay for a minute within Singapore. Let's maintain our position within our shores. And what you can see here in this graph, it goes again back in almost early 90s to today, is effectively a graph that, you know, things go up. As we said, you know, there's a bullish period. There's also a bearish period. And, you know, you could be buying this ETF, this exchange traded fund, and you could be buying some positions here and here and here and maybe here and maybe here. You can buy regularly, and effectively what you realize is that the overall long-term is upwards. Now, if you buy at a particular location, such as, for example, here, or if you buy up here, and you want to sell quickly, you might end up selling somewhere down here, so at a significant loss, or even somewhere down here. The idea is to respect that horizon, that cycle of the market, and allow it to average out over the long term. So a lot of these investments, that's why we call them passive investment, passive investing perspective. They're not the sort of day-to-day looking at your screen, trying to sort of take advantage of the market conditions, but instead invest in this, and in the long run, you actually see the benefits. And in this particular case, for the STI index, leaving or investing in that index, you realize that the average annual return is 7.9% with the dividends reinvested. So effectively, if you invest in different periods, you can still make that return by holding that position in the long run. That's what I'm trying to say with the long-term investment thesis. Now, the SDI ETF, for those of you who are active in the CPF investment scheme, which is effectively to optimize your CPF. We haven't talked about it today, but normally we have another session, another presentation on the subject. You'll see that under the SPF IC, the ability to invest in the Singapore ETF is there. So you can see it says Singapore ETF, Singapore SDI, and the name of the entity which is responsible for that ETF is the Nikko AM. And as you see here, is on the main board of the SGX exchange. So effectively, you're able to invest with your CPF into the SDI and take advantage of this 7.9%, provided that you invest for the long run and you allow the cycles of the market to go through. So that's the process. Now, a few years ago, when we were looking at ways to invest in the SDI, we found POSB, which has an investor saver scheme. At the moment, there are actually lots of other providers that you can get in Singapore who could do the same. They offer a similar sort of service. The interesting thing I'll share here is that with the POSB, you can invest as low as 100 Singapore dollars. So first condition is 100. You can invest as low as 100 Singapore dollars. You can go higher than that if you like, but basically it gives you that sort of flexibility. And the second thing is that as of now, the charges that you pay in relation to buying the SDI ETF is 0.82%. So it's a very small amount that you pay to actually get into the position. And you can actually have a regular savings plan where you don't have to actually sort of go in and put money on a regular basis. As Warren Buffett said, you got to go through the thick and thin. So there are going to be times when you see the market sort of dropping, like in this particular case, and you might be inclined to say, well, I don't want to invest when the price sort of goes down substantially. But effectively, the idea is to have it on an autopilot. So no matter what happens, you will buy at regular periods. You'll buy here, you'll buy here, you'll buy here, you'll buy here, you'll buy here. You'll buy everywhere, basically, according to what you have set up. And you won't have to worry about optimizing it or worrying whether it's the best time. Instead, you set it and forget it. And again, the POSB is one of the platforms that you can use, you can adopt. There are plenty of others in Singapore that you can take advantage of, but this is something that we've used in the past, and it seems to be a very interesting and easy to use sort of platform. Now, at the end of the presentation, I will share with you the manual in terms of how you can actually take advantage of that and understand how you can set it up and basically establish that sort of regular savings plan. Yeah, the manual is something that we'll talk about in a short while. I'm just conscious of time. Now, we talked about the SDI, okay, the Straits Times Index sort of ETF, which provides us with a average return on investment of 7.9%, okay, roughly 7.9% if we have reinvested the dividends as well, okay? Now, the question is there anything better out there? Is there something that we can really sort of take advantage of and really improve returns further? There is. And if we look at this chart, that's the chart, again, of Standard & Poor 500 index. So again, we can't invest in this straight away, but this is the index that shows us the prices of the US stock market over the years. So we're starting from as early as 1950 all the way up to today and beyond. And effectively, we have a situation where you could easily see that you have explosive periods as well as periods of retracement. So as I show here with the red arrows and the blue arrow, the green arrows are effectively the bullish conditions. The red arrows are the bearish conditions. So you have a bullish sort of situation, and then you have a bear. And one of the interesting things that I take away from this, and we all need to remember, is that there are actually three things that we need to remember here. The first thing is that this, guys, if I can. So, apart from the fact that you have bullish and bearish conditions, as you can see from the average trend here, it's up. Okay, so things are improving with time if you get to keep your index fund in position. But the three things I wanted to cover and I wanted to share with you about this performance here is that, first of all, we all need to remember that after a bull market, there is always a bear market. Okay? A lot of people tend to forget that, and they think that bull markets are, you know, euphoria and they're going to stay there forever and it's party all year long. But that is not true. Every time there is a bull market, it gets to be followed by a bear market. Okay? So that is important to remember, to understand that good times will be there, but not always. They will be followed by bad times in the market. Okay? The second thing to remember or to note is that when we have bear markets, okay, when we have these red sort of arrows, as you can see here, those red arrows are, so I'm going to say bears, okay, as in periods where the bear market is taking place. Bears are short-lived. What I mean by that, when the market turns, it turns very quickly and it doesn't last for too long. And we'll see later on a few very interesting examples of how that is. The problem with bear markets when they actually take place is that they scare a lot of people. They make them very fearful, and they think that this is the new norm that is going to stay for a long time. And the interesting sort of component here is that we need to understand these mechanics, because we'll see how we can take advantage of that in a minute. But the third thing we need to actually be aware of or remember is that the current it's going to be higher than the previous bull market. And what I mean by that, if this is a bull market, as is shown here, I'm just going to use this example down here. So let's say the price has started going up, right? And it's reached this sort of tops. That's a bull market. Then it retraces, and then it goes back up again. You see this? The market continues up. Now, this time it forms a top, it forms a high, which is actually higher than the previous high. So the current bull market is higher than the previous bull market. This is very important because if we look at the case of, for example, Japan, or the case of other ETFs, we will see that these phenomena, these behavior is not necessarily present all the time. And that is sometimes for us a red flag, a situation we say, hang on a minute, yes, something has gone up, yes, it has come down, but will it go back up again and exceed what it has reached before? Because if it doesn't do that, then our money is in trouble. So three things to remember here, that effectively we have the bull market followed by a bear market, we have the bears being short-lived, and we have the current bull market needing to be higher than the previous bull market so that we can say things are progressing and over time we're making money. So in this particular case, we are effectively having an average annual return, and I'm just going to delete all these things so you can guys read this clearer, we are basically having an average return of 9.9% per year compounded with the dividends reinvested. Now, the interesting thing to note here is that we are taking a very long period from 1965 and so on, where basically we average out the performance of the ETF. In reality, if we zoom into more recent sort of periods, if we zoom into times like, 2000 and beyond, you'll see that those returns that we are talking about, the 9.9%, they are actually more exaggerated. They are going to 10, 12, 13, 14%, because it's a shorter period of time. And what has happened in the markets is that they have started to become more volatile. So every time you have a bull market followed by a bear market, the next bull market is more explosive than the previous one, because lots of people want to come in. Now, somebody's asking on the chat about REITs, ETFs. REIT stands for real estate investment trusts. So a REIT, it's basically a fund that looks at real estate, and there is an ETF for that. Okay, so actually there are ETFs for pretty much anything you can imagine, for solar energy, wind energy, microchips, whether the market is going to go down, whether the market is going to go up, and anything in between. We don't cover these things because these REITs and these ETFs outside the traditional model that we're discussing here, they don't have the historical information that the S&P 500 does. And that's why we focus in America, because it's one of the largest markets. Everybody's watching it, and it has been around forever. And therefore, when we come into assessments of the nature I'm sharing with you, we are more comfortable saying, look, over time, this market has been doing this. Whereas for another ETF, in this particular case, a REIT ETF, it's a bit more difficult. It's a more concentrated sort of approach, and effectively doesn't have all the historical information. So I'm just going to delete it, but I felt like answering that question because it's a very interesting one. Now, somebody else is asking, is there any definition with limits or value increase percentage to define when the market is turning from bull to bear, or any other way around? Interesting question. You can come across things in the literature and economy saying, for something to be a bear market, it needs to drop by 20%. But frankly, these are definitions that people are just using, and many times they're actually challenging depending on the market conditions. So I wouldn't really want to put any specific numbers in there. And even if I do, it means absolutely nothing for us. We just need to understand the fundamental things I've mentioned, where after a bullish market, there's going to be a bear market. There's no doubt about it. We need to remember that. The good times are always followed by bad, and the bad are followed by good. Then we also need to understand that when the bad times come, the bear market comes, it's a very short-lived market. And this is what gets a lot of people unprepared, because they think that, this is the new norm, it's going to stay here forever, and so forth. But in reality, it doesn't. And the third thing is, as I said, in order to invest in an ETF in a particular index, we need to see, perhaps in the past with historical information, that the latest bull market has been higher than the previous one. So you have a trend that says, look, things are going up and not down or staying flat. The other questions, which I'm going to probably try to answer a bit later on, because I'm just conscious of time and I don't want to be sort of stuck in just one slide, because I know that I could create lots of interesting sort of questions here. But the thing to take away from here is that we're looking at the S&P 500, the 500 largest companies in the US. They've been around since 1905, if I'm not mistaken, or 1903. So more than 100 years of history and data and ups and downs. Now, you might be asking me, where did I get this 9.9% sort of average return? Now, Berkshire's report from Warren Buffett, it's an annual letter that he issues to his shareholders. And you can go to Google and type in Berkshire Hathaway Annual Report 2022, and the PDF of that report will come up. I highly recommend you read it because it's a very interesting piece of information. Normally it's about 10 to 20 pages long, but it basically talks about what they did the year before as Berkshire Hathaway, where they invested, but it has a lot of nuggets about the market overall. But in the main page of that letter, the Berkshire Hathaway annual letter, there is information about what happened to the S&P. And as you can see here, it says compounded annual gain of the S&P from 1965 to 2022. Okay, that number is basically 9.9% per year. Now, if you had invested in the Standard & Poor, the S&P 500 index in 1964, and you kept it to today, you would have had a gain of 24,708%, which is enormous, guys. It's phenomenal. And to me, it demonstrates the concept of compound effect. 9.9% annualized and compounded over a significant period of time, it yields impressive returns overall. So that's where we got the 9.9%. But as I said, if you start looking at a different time period, if you start looking from 2000 to 2022, this 9.9% becomes much more advanced, much more elevated, because the conditions have become completely different to perhaps the conditions in 1965. More of us are basically in the markets. More of us are trading, investing, putting money in the exchanges than in 1965. And therefore, there's more dynamic, there's more volatility. So when things move, they move a lot, as we'll see in a minute. So this is the S&P 500 index, not the fund, the index, which basically tracks the average performance, the average price of the 500 largest stocks in the States. And what you can see here is an interesting arrangement where, you know, you have periods of up and down. And if you look at one of the recent cases of bull and bear, in 24th of May 2000, we had the top of the market, the top of the bull market at 1,527 points. Now, what happened after the 21st of March was basically carnage, was basically sort of disaster, where effectively the market collapsed and dropped to 800 points on the 4th of October 2002. So 2 years later, it's taken, you know, the market down by a mere sort of 50 or close to 50%. Now, the interesting thing to note here, and this is what I was saying about the bear market, the bull market followed by the bear market, but the short period of the bear market is, if you look at the way that the market moved up, it's taken them quite some time. It's taken them from 1990 all the way to 2000, so almost about 10 years. But to come down and stabilize and stop that sort of drop, it's taken 2 years. So 10 years to go up, 2 years to go down. Okay, so when the bear markets happen, they happen violently, they happen quickly. And this is what I was saying about the short living of the bear market in the condition. Now, the other interesting thing we need to see here, as we said, as a third point, is that we want the market after it's dropped to go back up again, to exceed the previous high. So in this particular case, on October 12, 2007, the market exceeded the previous high of 1,527 and is gone to, perhaps it's not really that visible on the chart, but it's gone higher to 1,061. That was in 2007. So this particular example is one of the cases of a recent bear and bull collapse, bear condition, bear sort of correction. In 2007, we had the market higher than before. And what happened is that the price effectively from the top, so excuse me, from the bottom here, the price from this point to this point, that amount is 95%. So it dropped and then is recovered and it made 100%. So if you were scared, and going back into Warren Buffett, if you were scared and you didn't buy the ETF because, the markets were collapsing, everybody was scared, you wouldn't have been able to buy at this position if you didn't have your autopilot, your automatic investment mechanism. And you wouldn't have been able to make this 100% because things were going to move quite quickly. The market would come up. And by the time you would think about investing in the market because you realized that the market moved, it might have been a bit too late. And you certainly wouldn't have made your 95%. So really the point with the thick and thin is you set it up in an automated way and you buy along the way at different points. Now, whether these points are up or whether these points are down, you don't really care because effectively what you're looking at is the long term, and the long term is actually up. Okay. Now, moving into 2007, as we've seen earlier, we have a situation where the price of the market sort of topped on the 12th of October. And again, in less than 2 years, the market collapsed to 683, which represents a drop by 56%. Now that is phenomenal drop, guys, and scares everybody out of the market. For those of you who have perhaps been active in the space or have been following the news back in 2007, the great financial crisis, it was like the sky has just fallen, okay? 50%, 56%, banks were failing, governments were failing and everything. So people were very, very scared. But this drop didn't last forever. This drop lasted for 2 years. It was very severe. But then what happened is effectively the market recovered. So when you look at the price as of today, which is as of yesterday, as a matter of fact, because the markets are closed right now, the price of 4,405 this is the price I'm trying to show you. So if you had invested, as we said, on a regular basis, and you have invested down here and here and here and here, all the way up to this point, or even higher perhaps, this point, excuse me, then this ascent is 544%. And that is from 2009 to 2022. And this is what I was saying about the overall average that over, the period of 1965 to 2022 is about 9.9, 10%. But if you were investing in the market in the same way as we're discussing today, but in a shorter period, in recent history, you would have seen that the prices have been very, very volatile and able to provide and to reward you handsomely, basically. But you had to be having the guts, the ability to buy down here, to buy here, buy here, to buy perhaps on the way down. And the only way to do it is to set it and forget it, to have an automatic mechanism that buys it for you without you having to worry about and worrying as to whether this is the right time or not. You have to set up a fixed amount and you have to set up a fixed period. Let's say a certain percentage of your money or a certain amount and a certain duration, let's say every month or every quarter or every year. Now, moving on to the last example I have here, and I'm just going to try to speed up a little bit because I know you guys are probably getting a bit sort of tired of the webinar today. It's taking us quite some time, and I do apologize, is the recent sort of crisis, the recent sort of collapse of the market, which has taken place, as we all know, around about February 2020. We have the interesting case of COVID happening, okay? So what happened is that the price of the S&P 500 at that particular point was 3,380. And what happened after that is effectively dropped, okay, to 2,237. Now that drop is 33.9%. And if you see the duration is from the 14th of February 2020 to 23rd of March 2020. It was so quick. It was so rapid that most people didn't react, didn't do anything. So nobody bought down here. Nobody bought here. Nobody bought here. Everybody waited for things to improve and end. And effectively what happened is that they lost the 96% upside from this point all the way up to this point. That's a 96%. So again, we have a bull market is going to be followed by a bear market. The bear market, most of these bear markets that we're seeing now, they're happening even shorter in duration. They're rapid. They're very aggressive sometimes. They scare everybody else off. And then we continue further on where we see even impressive results on the bull side of things. So the way to do it is to be able to automate it, not to have to guess, not to have to worry about the timing, and not to leave it to us when we are fearful, when we're scared to whether we invest or not. So if we look at the overall picture here, what you see is the S&P 500 from or since 1952, where so many things have taken place: wars, crises, and everything in between. And effectively, what Warren Buffett famously said in 2009 is that there's no way you can bet against America and win. And he didn't say it because he's American, but because the S&P 500 has the 500 largest companies in the States, and those are trading globally. They affect the global trade. And therefore, it's a bit of a silly bet to say, well, I'm going to go against America because I don't like the American economy. The American economy governs or affects all economies around the world, whether we like it or not. So the safest bet for us is to go with the flow, to go with what we're seeing, which has been tried and tested over a long period. So how do we invest? How do we invest in an ETF? And when we look at the history here, you can actually see that the trend is up. This is the important thing. And as I say, perhaps I'm just repeating myself several times here, but the assumption is that the US will continue to prosper because historically we've seen the prices to go up, okay, no matter what happens. And the second one is to invest consistently in the long run, to live long enough to see the long-term growth. Because if you invest in a short-term basis, maybe the cycle will not be advantageous for you. Maybe this whole process will actually make you lose money. The idea is to invest, keep it in the long run, and you will see the benefits of having that investment in the long run. Somebody's asking if there's a 9-year-old statement. A 9-year-old statement still stays true. I guess what you're referring to, Rajesh, here is basically the 9%, 10% sort of return on the ETF of the S&P 500, and the answer is yes. As a matter of fact, it's even better if you had invested somewhere between 2000 and 2022, somewhere between the early stages rather of 2000 and kept it to today, the returns you would have seen would have been even higher. Somebody else is saying Buffett's comment may not hold true in future given recent developments in BRICS and de-dollarization. Okay, that's very interesting, guys. I guess it's a good point. I'm not going to argue that, but I don't have the answer. And frankly, we're just using significant historical experience to make a judgment about what will happen in the future. Now, nobody knows. Nobody has a crystal ball. And frankly, we want to have an automated system that doesn't make you lose your sleep at night, but instead allows you to do other things in life and invest without having to worry. Now, if that proves not to be true in the future, I don't know. Nobody knows. But the history of 100+ years has shown that no matter what happens, you got crises, you got wars, you got all sorts of situations. The United States, whether we like it or not, has managed to maintain their position in a global basis, and their markets have continued to so the components of the S&P 500 for us to sort of understand, because this is a breakdown of the total market capitalization, basically what the S&P 500 index consists of. And if you look at just this part of the circle, okay, which is round about maybe a little bit more than 25%, okay, this includes companies like Apple, like Microsoft, Amazon, Nvidia, Google, all these companies. These are the largest companies. They operate globally. They're listed in the exchanges in the US, and effectively they form a large portion of the S&P 500. Now, if you were to invest in these companies separately and basically why I'm just stopping, guys. Apologies. And basically, you were to buy these stocks individually. You buy Apple, you buy Microsoft, you buy Amazon, instead of like the ETF. As a minimum, to resemble this 25, 27% box that I'm showing you of the ETF, you will have to invest, you'll have to start investing with $2,737. Okay? So you buy all these companies, one share of all these companies to start with. This is your investment. And it's not even balanced because you're just buying them in an equal number. Whereas in reality, you should be buying 7.6% of Apple, 7% in Microsoft, 3.1% in Amazon, and so forth. So the economics and the mathematics becomes more complicated. But what if I tell you, and I don't have to tell you, you can imagine you can start with a much smaller amount, almost as low as $100, where basically you don't just invest or participate in 25% of the market. Instead, you have exposure to the full S&P 500 index, okay? This is the ETF we're talking about. We're not investing just in Apple and Amazon and Microsoft. We're investing in all 500 S&P companies, and we don't have to do it with the full amount. As a matter of fact, I was looking at, if you want to do it physically by just buying each of those 500 companies, one stock of each, you would have to invest something like 9.7 million as a starting point. Okay, so we're not going to go there. We don't have that much money. We don't want to have that money, even if we did have that money allocated to this. Instead, we invest in the ETF, which allows us to go as low as $100. And we can do it in an automated fashion where we set it and forget it. So the best way to do it is to use something that's called dollar cost averaging. And you'll probably see this in presentations from other people as something that is called DCA for short. And what does it mean? It means that you invest a fixed amount of money into the asset class, into the ETF that we talk about here, the S&P 500 ETF, okay? Fixed time interval. So you say, I'm going to invest a certain amount, and I'm going to invest it every now and then, every time that I actually set it as such. So basically, give you an illustration, you could go and invest yearly, or you can do it quarterly, or you can do it every month, your choice. But the idea is to set it as such and maintain it, because as we've seen, there will be ups and there'll be downs. So you want to take advantage of the average condition. So you invest $100 into the S&P 500 for year one, year two, again, the same, year three, and so on and so forth. Now, one of the companies that can actually sort of do this in Singapore is a company called Doladex. We're not associated with them. We don't have any sort of benefits or interest, or we don't promote them, but we just know that they have the ability to offer the dollar cost averaging. And interestingly enough, they have the ability to invest in the S&P 500, not in US dollars, but in Singapore dollars. So if you guys don't want to be exposed to the exchange rate between the Singapore dollar to the US dollar, you could invest in an S&P 500 in Singapore through Doladex, which invests in Singapore dollar amounts. Now, the description of the fund is called the Infinity US 500 Stock Index Fund, which basically tracks or aims to follow the long-term capital appreciation of the Standard & Poor's index. It's undertaken by a sub-fund of Vanguard. And the one I'm showing you on the screen, and you can go on the website of Doladex and check it out, is in Singapore dollars. You can select the one in US dollars, but you can actually sort of set it up in Singapore dollars, and you don't have to worry about the actual exchange and how much. If you were going to invest 100 Singapore dollars, how much US dollars will effectively reach and buy the portion of the ETF. So you don't have that sort of risk. You know exactly upfront how much you're getting. You can see the recent price. Okay, this is a little bit outdated, but the price was 2,350 Singapore dollars as an ETF for the S&P. I'll share with you how we're going to be able to go through some of the interesting information and access the manual and how you can sort of tap into it. So getting back into what Warren Buffett said again, 90% we put it into a fund. We put it into effectively a low-cost index fund. So we understood what an index is. We understood what an index fund we understood what the S&P 500 index fund is, the last piece of the equation is to understand the very low cost. Now, what does he mean by very low cost? Now, in the world of ETFs, the world, the cost relates to something or is used, is explained as ratio is another word or phrase. It's costs, things that we have to pay because we are participating in the ETF and we are able to play the market. So an expense ratio is the important one. So if the expense ratio is high, and normally is calculated as a percentage of the ETF participation, then the higher the expense ratio, the more money we pay to the administrator, to the entity that manages the ETF, and therefore the less money we actually invest in the ETF itself. So we need to keep this as low as possible. That's why he says a very low cost, very low cost. So we talked about the SDI in Singapore, and here I'm just sharing with you 3 ETFs that you can invest in the S&P 500. First one, has a ticker symbol VOO. Second one is IVV, and the other one is the SPLG that you can invest via Singapore brokers, and you can set it up as an autopilot with $100 per month without any additional fees. Now, all of these 3, we've investigated them, and we have seen that they have the lowest expense ratios of 0.0% for all of them. So these are the lowest cost index fund that you can invest in. You can invest in VOO or IVV, IVV or SPLG. Your call. And as we said, you're looking at 10% plus in these cases versus the SDI, which is about 7.99%, 8% sort of general for Singapore. Okay. Now, the interesting thing is that I would love to show you ways to cover investment approaches that they can yield higher percentages, because we're talking about 10, 15% with these ETFs, but there are ways that we can go even higher. We can go to 20%, and we can use methods such as the one that I was applying to, I was alluding to earlier with the significant historical participation of 100 plus years old with low capital involvement and no monitoring of the stock prices. As Yang Zi was saying earlier, the important thing in investment is not to sort of sit in front of a screen and look at the prices and be disappointed one day and be euphoric the other because prices have gone up or down. The idea is to set something up to be able to do it for the long run and effectively go on with your life and take on a new hobby, spend time with your family, travel, and do whatever else you want. If you're going to replicate your day-to-day job with another job where you're just staying at home and looking at screens, I would suggest you stay with a full-time job instead of monitoring the stock prices. The idea here is not to do that, to do it in an easy way and to do it in a way which is a proven method and has worked for a lot of people. Now, I don't have time for all of this. I'm just very conscious of time. It's just over 1 o'clock, so I'm just going to try to wrap up as quickly as possible. But I want to share with you a very interesting little video from Monica. Monica is one of our graduates who has recently shared a video with us and told her story. And it's going to be very interesting to listen to this because she started a journey that allows her to effectively be financially free. So let me see if I can share the screen and basically play this video. Apologies. For some reason, my internet skills today have failed me. So in the context of and pressure of time, what I'm going to do is I'm just going to continue my presentation. Monica basically shares her story, and you can actually go to the VIA YouTube channel, see her video there. It's posted. But the point is that in order to achieve better returns, in order to be financially free, you need to learn more. You need to understand more. There's no way. What we've covered today is a fantastic sort of step in terms of enhancing your understanding on the investment world and taking perhaps your first steps. But you really need to learn more. You really need to understand the aspects of investing. And this is where Caden, the value investing founder, is conducting. It has two masterclasses. One is on the 6th of September, Wednesday, 7 till 10. The other one is basically on the 21st of September, again in the evening. And because this is an on-site registration, this is not an online event just like this one now, I would say that you have to register, because it might be difficult to secure a slot. So what I'm going to do is I'm going to ask our guys to basically post on the chat box the tickets. And I think that has been done already. So wonderful. Thank you so much. So the ticket for the 6th of September is on. The ticket for the 21st is also on. So choose a date that you basically sort of key in and log in and sign up. The information is very basic. There's not much sort of preparation there. You just need your name, your telephone number, I think, and your sort of email. And basically the way it works is that you have to turn up basically in the registration. You have to go to Shenton House, where Value Investing Academy is located. Caden is going to be conducting this masterclass live and physical. So you guys need to just turn up basically. And what you do by just doing this sort of action is effectively on the registration at arrival, you'll be given a printed version of the manual for the investments arrangements for the STI in Singapore, the Straits Times Index ETF. So you can invest in an ETF, the ETF in Singapore straight away. And at the same time, you'll get another printed version of the manual of how to invest in an automated way on the S&P 500 index fund with dollar decks. These are physically printed manuals that you pick up on registration. And the only thing you just need to do is basically turn up and pick these things up. Now, these are the two things that you'll receive. But apart from that, sitting through the masterclass, the 3-hour masterclass, which is going to be highly entertaining as well, because Caden is a great sort of storyteller, a great presenter, is that he will teach you how to generate 3 sources of passive income, even if you know nothing about investing. Okay, 3 very important ones. And that with very, very limited or minimal capital. You don't really need to invest a lot of money. And as a matter of fact, we promote the idea of starting small and growing your confidence. And one of the sort of strategies you will learn is a cash dispensing machine strategy, or it looks like one of them, which will allow you in a very short period of time to replace your existing salary. So if you don't want to work, you don't have to work, and therefore rely on this cash dispensing machine that you learn to allow you to retire or be financially free and do whatever you want after that. Now, the thing I wanted to show you is that on top of that, by turning up, you will receive a hard copy of a $25 book, which is the Value Investing book, a wonderful book, which I have in front of me. Pretty sure I'm showing it to you. Hopefully you can see it, which is a book written by Caden Chang about investment. It's a very sort of small one, easy to read, very easy, but is full of information and interesting sort of nuggets as far as your investment journey is concerned. So you would love this book, which if you go to the market, you'll buy it at $25. On top of it, you will receive a voucher from Starbucks, $10 to have a cup of coffee. And going back into the book, one of the recommendations you'll see in the introduction is from Lauren Templeton, who is the founder and president of the Templeton Phillips Capital Management. Lauren Templeton is the descendant of one of the most famous investors of all time, Sir John Templeton. And she said for this particular book that I highly recommend Caden Chang's book and his investment courses to anyone who's interested in getting started on investing, which is a very high recommendation for a book. And I can tell you, I read this book. I have it full of notes, full of full of highlighting bits and stuff, and I constantly read it because it's a wonderful reminder on the investment journey. And this comes for free by just turning up and basically signing up and witnessing the 3-hour masterclass. Now, on top of it, and I keep sort of adding bits here, but I hope this is I think this is the last slide, so I'm going to stop here, is if you bring 1 or 2 of your friends during the masterclass, you will also receive $20 worth of NTUC vouchers, plus $20 of movie tickets. So food is on us, watching a movie is also on us, and your friends that have come along with you will also receive a copy of the book and a $10 gift card from Starbucks. So you can go to Starbucks afterwards, and all of you have a cup of coffee and talk about investment and how you start your journey. So with all of that, you're basically sort of signing up for the masterclass, which is coming up, and I highly, 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 highly recommend it. And I'm not downplaying this, and I'm not exaggerating, but it's one of those events that it will definitely change your journey. So I'm going to stop here because I'm just conscious of time. I think we've exceeded time a lot. I'm just going to hang around for a little bit. I'll give you time, guys, to go and log in to the links that the VIA team has posted. And again, to select a date that you guys will attend. Bring a friend or 2. Take all these goodies with you at home. But more importantly, take all this information, apply it, and I can tell you from personal experience, it will change your life. And it will allow you to do things that I have, do things that you're interested, you want to do. I'm just looking at the comments here, and I'm just going to look at some of the questions that have been raised. Somebody said, I've registered for myself. Should my friend gets interested, can add him later. You can, of course, you can do that on the registration, or you can bring your friend along, and during the masterclass, you'll find out about it. Yeah, the VIA team has just responded. You can inform the team through WhatsApp. So I'm going to go through some of the comments that you guys have made, but I am going to stop here the presentation. It's been fantastic. I still see 86 of you holding on, hanging on. So I sincerely want to thank you for your patience, for your interest. I want to thank Hillary and Yangzi for their wonderful presentations. I hope the content and the information we share with you was good, was genuine, and was useful for you to propel forward in your investment journey. And I wish you all the best. I wish you every success in your investment journey. And I will just wait here. I'll answer a few questions. You guys take your time. If you need anything, just, keep texting us. The VIA team is here with me. But for those of you who are dropping out, thanks very much. Enjoy the rest of your weekend, guys. It's actually Saturday morning for me here because I didn't say this earlier, but I was recording this from Geneva, which has been 3 o'clock in the morning. Now it's 6 o'clock in the morning. So I've been doing a bit of an overnight sort of session. So I hope I did okay, and I hope it was useful for you. So appreciate your patience and your participation. Everybody saying feeling excited for the masterclass, Kichong? Yes, that's right. That is great, guys. And you'll see for you can also go into the VIA channel and you'll watch a few videos. And one of the things that you'll actually see is effectively a trend, a way that this information in general knowledge gets to be displayed. We're not trying to sort of pump up things here. We're not trying to sort of say to you what you buy or what you sell or recommend. We're very cautious ourselves because we are also trading. We're also investing our own money. So we are very, very understanding of your situation because we have been where you've been and started our journey. All professionals, someone said, were once upon a time an amateur. So you'll see from the videos in Value Investing YouTube channel that people are very cautious. They do a lot of work. They do a lot of understanding and research in order to pass this information to you because it's interesting, and it gives us pleasure to be able to share these things and see people who really have the interest of moving on in life, doing something more apart from just leaving the money in the bank account to propel forward. So somebody was asking earlier about, do you invest monthly or yearly in the ETF? My personal sort of choice or reaction is that I have set it up on a quarterly basis. So every quarter, I set up an amount, and I have set it up for my son as well. So I don't have to basically sort of worry whether I put money aside and it's something that I have forgotten. And I will look at it in 5, 10, 15 years from now and decide as to whether I want to cash out or I want to continue. Of course, there's always a need to look at things, because I remember someone basically talked about you cannot be passive, says, on investments regardless. And I fully respect that. I fully understand that. Perhaps conditions now in the markets have changed to require us to be a bit more active. But the purpose of our sharing today was not to necessarily say you guys need to be looking at your screens, need to understand all the technicalities and fundamental information. Instead is do your first step, start walking. And once you start walking and you start developing that confidence that you know how to walk, maybe you can start running. Maybe you can start sort of going a little bit faster. Maybe you can start doing a few other things, maybe jumping along the way. But we're not, the idea here is to take you through the process and effectively hold you by the hand almost and allow you to enter this world, which frankly is a world that it looks from the outside very complicated and difficult, but it doesn't have to be, guys. Someone is asking, okay, so if we were to invest in IVV, VOO, SPLG. Now, something here to clarify so we don't get confused. We're not advocating that if we're going to go and invest in an ETF for the S&P 500, we got to invest in all three of those. No, one of them is enough. In my particular case, I have a position in VOO. I invest in that. But you can look at this and maybe through the broker that you have, you might be having flexibility, and perhaps SPLG might be a bit more suitable investment position for you. But the locking period that you talk about, a locking for 5 years minimum and continuously invest is close enough. I would say the thick and thin is really important, because frankly, if you believe that when times will turn bad and the market is going to be bearish, you will take the initiative to go online and to invest 100, 200, 500, or whatever amount you normally invest, it's going to happen. You are mistaken. It's not going to happen. So at that particular point, everybody, including you, me, and anybody else in the market, they will be scared. So the last thing you want to do when the market is crashing is to say, oh, let me go to the bank, get some money, and I'll go and invest in the stock market, which is crashing right now. No way. So the idea is to automate it. So set up a certain amount, whatever amount you're comfortable, and we'll talk about this in a minute, and set it up on a regular basis. Whether it works for you on a monthly basis, do it monthly. Whether it works for you quarterly, do it quarterly. Whether it works annually, fine, depending on your cash flow conditions, right? Now, the concept of investing in an amount that you're comfortable, this is where I want to go to with a 5-year period you mentioned. When I say comfortable, is like you need to put money aside for your investment that you can afford to leave there for some time. Because if you think if I make $100 and I'm going to put $100 into the market, then effectively it's going to be very difficult for me to survive. So the idea is to have this money aside that you don't really need to live on. You don't really need right away. Now, whether it's 5 years or 2 years or 10 years, nobody knows. But the idea is to leave it there and not having to rely on it and expect to take it back at a particular period. Because that period in the future that you might want to take it out, it might not be a very good sort of time. So the idea is to leave it and look at the market, see what the ETF does over time, and be able to benefit from the long-term performance. This is what I've said earlier about the average return on an annual basis. If it's compounded, or when it's compounded it's like it goes into an exponential growth, which is very hard for us to understand. So the 3 points for S&P 500. Any pointers, observation for SDI index? Good point. The SDI index, again, full disclosure from my position, I also have positions in, I've invested in the SDI ETF. It's a little bit slower, and frankly, the past few years now, it has been a bit slow, a bit less reactive. So what I did is that I have reduced the amount of money that I continue to invest. I have kept the periods of investment as is. So in the SDI, I invest annually, but I don't invest the same amount as I used to. So I put it down a little bit because personally, it's just my opinion. I'm not trying to influence, sharing my thoughts about the SDI index. I haven't seen the significant sort of upside that I would have expected after COVID to be present. It looks like there's certain parameters that they are still holding the SDI index within a certain sort of range, and it doesn't go too high up. But nevertheless, you got to remember the SDI index has got dividends as well. I can't remember off the top of my head now the dividend percentage, but effectively you reinvest that, and with time that continues. The SDI index could be a very interesting consideration for someone who has not done before, is a bit kiasu and doesn't want to sort of go to the US and be concerned about brokers there and exchange rates and so on. And you could start with an SDI investment, SDI ETF investment, and basically to learn to get a better feel. Because I can sit here and tell you all about buying stocks or buying ETFs or buying this or buying the other. It's effectively, it's a personal choice, it's a personal decision, and that experience, nobody can actually replace it for you. You can read as many books as you want on the subject. It's a completely different psychological reaction the minute you go online and you press the mouse button and you buy something. Only DollarDex can buy S&P 500 in SGD. Can Think and Swim platform POSB buy the S&P 500 in SGD? Good question. I don't know the answer for POSB. The manual that you will get from the on-site during the on-site registration will certainly cover this. If they don't, and if you want to find out the answer pretty quickly, I suggest you go to POSB's website now and check for the S&P 500 index and the optionality it provides. The TD Ameritrade, or the Think and Swim, which is the platform that TD Ameritrade uses in the States, and it's a registered broker in Singapore, invests the S&P 500 in US dollars. As a matter of fact, everything or anything you do via Think and Swim is in US dollars. Now, the main differences and benefits. I'm just going to go to the last one, guys, and then sort of, hopefully sort of leave it to complete the registration. Paul Long is asking, what's the main differences and benefits buying the S&P 500 between SGX and US platform besides the trading hours? Thanks. Again, in terms of the sort of technicalities, a lot of the brokers in Singapore, the commission fees they charge could be prohibitive sometimes for smaller amounts. So if you're looking at, as we said, 100 Singapore dollars per month, could be sort of a significant amount going into their commission charges. The interesting thing as well to note is you need to understand from the Singapore broker as to whether he will invest in the ETF in Singapore dollars or in US, because then the exchange rate will be an issue. But the S&P 500 for the US platform accounts or is also a very easy one in a sense that the commission fees that a lot of the is the US brokers are offering are very low. And in Singapore, there are only 2 registered with MAS brokers, US based. One is TD Ameritrade, the other one is Interactive Brokers. You can go through either or of them. Basically, their commissions are zero for buying and selling ETFs. So that's a benefit. The trading hours, I'm not sure if there's any real benefit. I think execution takes place pretty much at the same time. So not so sure. Just going to end it here. Will the volatility in the ETFs make any difference? No, because really we're not looking at volatility. We're not looking at the screen and basically trying to optimize the position on a short-term period. So if it goes up and it goes down and it's moves around, fine. We're looking at the long-term horizon. We buy regularly. We buy a specific amount and we set it for the long run. Do we always need a human broker to help buy an ETF? Can we do it ourselves? Correct. We don't need a human broker. As a matter of fact, what I was saying earlier about the automated approach is once you register and you get the manual for the step-by-step for the STI and the step-by-step for the S&P 500, you will understand that this process is automated. So you say to the broker, take from my account or take from whatever arrangement you have with the broker in terms of setting up your flows, take $100 or whatever the amount is, okay, every end of the month and put it into the ETF. So you don't need to actually sort of do anything in the whole process. It's something that is completely automated. Human brokers are basically quite extinct now. Majority of transactions are actually done online and by yourself. So if you want to go every month and say, look, I'm very disciplined on the 30th of every month at 10 o'clock in the evening, I'm going to go online. The market in the US is open and I'm going to buy $500 of S&P 500. Fine, do it. But it's much easier when life gets in the way to say, look, I don't need to think about that. For now, until, perpetuity, take X amount from my account and buy the ETF for the S&P 500 and keep it for me. So I think we are getting there. So thank you VIA team, by the way. And apologies for the internet connection, but I'm pretty sure we'll get better, hopefully, the next time. Sometimes internet can be unstable. Thank you, everyone. We will end the Zoom right now, and we will see you soon on the masterclass that's coming up in September. So thanks, everybody, and have a great weekend.